Please like, share, and subscribe. Wishing you happiness and good luck every day.
There's this question that hangs over every investor, whether you're just starting out or you've been at it for years. Is it really possible to turn a small, modest investment into a truly life-changing fortune? Well, today, we're going to crack open a classic, Thomas Phelps's 100 to 1 in the stock market, to see if we can uncover the secrets behind those absolutely extraordinary returns.
Just think about that for a second. $1,000 turning into $100,000. They call it a 100-bagger. It sounds like a pipe dream, right? The kind of thing that happens to other people, lottery winners maybe. But what if I told you that it's not really about luck at all? What if it's about a philosophy?
Because here's the kicker. According to the research Phelps did for the book, since 1932, over 360 stocks have actually done it. They've delivered that incredible 100 to 1 return. So this isn't some myth. It's a real, documented thing that has happened again and again. The real mystery isn't if it's possible, but why so few of us ever get to experience it.
And this is where it gets really interesting. Phelps tells this story about a man he calls Mr. Blank. His lawyer was just floored by how much wealth this guy had built up and asked him point blank, "How did you do it?" The answer was so simple it's almost hard to believe. He just said, "I never sell anything." That one little sentence, that's the key that unlocks this entire idea.
So, okay, we've established that these massive returns are out there. They're possible. But, and this is a big but, knowing the promise exists is one thing. Actually having the right mindset to achieve it is something else entirely. This is really a deep dive into our own psychology, where the biggest opponent we face isn't the market, it's ourselves.
So how do we start to build that mindset? Well, Phelps gives us this absolutely brilliant metaphor. He says most of us investors, we spend our entire lives hunting for what he calls guinea hens. Those small, quick, easy profits. And while we're busy doing that, the real prizes, the elephants, they just walk right on by, completely unnoticed.
And he learned this firsthand. This wasn't just some abstract idea. It came from his own experience hunting in Africa. The second he took a shot at some small game, the noise, the distraction, it scared away anything big in the area. It's the exact same thing in investing. Chasing those little 10 or 20% gains creates so much noise in your portfolio that you completely miss the long-term compounder that could change your life.
So just take a look at this and be honest with yourself. Which one of these sounds more like you? The guinea hen hunter is glued to the news, trading in and out, trying to scalp a few points. But the elephant hunter, they're playing a completely different game. They are obsessed with the business itself, not the stock price. They ignore the daily chatter, and they practice a level of patience that most people would find, frankly, boring.
And this right here is the absolute crux of the issue. The market's going to do what it's going to do. It's going to swing wildly, it's going to have panics. That's a given. But the real roadblock, the thing that stops most people, is their own internal wiring. It's the fear, the greed, the impatience, all the emotions that tell us to do exactly the wrong thing at exactly the wrong time.
Phelps lays out all of these little mental traps we fall into. Just look at this list. How many of these sound familiar? Oh, the stock's run up too much, I gotta take profits. Or, it's not doing anything, I'm bored. None of these have anything to do with the actual business. They're just emotional reactions, and they are the very reasons people end up selling a future 100-bagger way too early.
Okay, so let's say we're on board. We commit to hunting elephants. We commit to trying to control our own worst impulses. The next question is obvious, right? How in the world do we find these elephants to begin with? And that brings us to the second pillar of this whole thing. You have to buy right. Now, this might be one of the hardest pieces of advice to actually follow in the entire book. It's just so counterintuitive. The biggest opportunities, the real life-changing investments, they're almost never the ones everyone's talking about. They're usually hidden away in the corners of the market that are forgotten or misunderstood or sometimes even hated.
To make it more practical, Phelps shares a framework from another successful investor, Paul Garrett. First, you have to look for small companies. Why? Because a huge company just can't grow at an explosive rate. Second, look for the unknown. You don't want to be paying up for a story that everyone already knows. And of course, you have to find a business that's already growing fast. The whole idea is to find tomorrow's giant while it's still a tiny sapling.
Now, this next point is absolutely critical. When Phelps talks about growth, he's not just talking about earnings going up. He's talking about real growth. What that means is the company has to have a special sauce, some kind of competitive advantage that allows it to take its profits and reinvest them back into the business at incredibly high rates of return. It's a compounding machine.
So your job isn't to be some kind of fortune teller trying to guess what a company's going to earn next quarter. No, your job is to be a business analyst. Your job is to find that unique thing, that gate against competition, as Phelps calls it, that lets a company keep reinvesting capital at a superior rate, not just for a year or two, but for decades. So, buying right. That's half the equation. It's a huge part of it. But even if you manage to find the perfect company at the perfect price, it'll all be for nothing without the third, and, let's be honest, probably the most difficult part. Phelps shows us that the real magic, where the truly mind-boggling wealth is created, comes from what he calls the superpower of holding on.
Just look at this number for a second. Let it sink in. In a 25-year run that gives you a 100-to-1 return, more than 60% of that entire gain can happen in just the last 5 years. Think about what that means. You could hold a stock for 20 years, get a 40-fold return, which is amazing, sell it, and still leave the majority of the money on the table. It's insane.
And that's exactly why holding on is so powerful. True compounding isn't a straight line up. It's an exponential curve. It starts slow and then goes vertical. Selling early is like building a rocket ship, fueling it up, and then jumping off just as it's about to break through the atmosphere. You don't just miss out on a little more profit, you miss the whole point of the journey.
And if you think this sounds easy, just remember that Phelps himself got humbled by the market. He tells this painful story of buying a stock he thought was a bargain, but he used margin, leverage, and when the stock went against him, he was completely wiped out. It was a brutal lesson on why trying to be clever and time the market swings is just a fool's errand.
So this all brings us back to the central theme, the core thesis of this entire book. It's not about being the smartest guy in the room. It's not about brilliant trading or complex market timing. It all boils down to a very simple, very powerful truth. Lasting wealth is built by doing two things: buying right and holding on.
So after laying out this incredible roadmap, Phelps does something really clever. He turns the questions back on us, the readers, on you. Because understanding the theory is easy. The real question is, are you actually prepared to do what it takes to put it into practice? First, are you ready for the sheer amount of work? This isn't about getting a stock tip from your buddy. Phelps talks about how Paul Garrett sifted through a list of over 50,000 companies just to find one. It takes a massive amount of research and diligence before you ever click the buy button.
And what about this one? Every single great company in history has gone through terrifying price drops. I'm talking 50, 60, even 70% declines. The price of admission for those elephant-sized returns is being able to sit through periods of unbelievable pain and doubt without panicking. Do you really have the stomach for that? Now, holding on doesn't mean you just buy something and forget about it. Phelps calls for eternal vigilance. There is a huge difference between having the courage of your convictions because your research is sound and just being plain stubborn when the facts have changed. You have to be able to tell when your original thesis is actually broken.
And that leads us to this final, really profound question he leaves us with. Forget about the stock for a minute. What is the one business you would be willing to own a piece of for the rest of your life? Really thinking about that question forces you to consider everything. The culture, the competitive advantage, the long-term vision. Answering that, well, that's the first real step on the path to becoming an elephant hunter.
So, what in the world does an ancient story about a desert, an angel, and a donkey have to do with building real, life-changing wealth? Well, as we're about to see, absolutely everything. This is a story about ambition, and it all kicks off with a simple choice that, believe it or not, most of us get wrong every single day. Okay, so picture this. You're out in the middle of nowhere, sleeping in the desert, and suddenly this brilliant light wakes you up. Out of it steps an angel with an unbelievable offer. Each of you gets one wish, anything you want. I mean, talk about the ultimate test of your imagination, right? And the choices these 5 men make, well, they reveal a powerful truth about how we approach our own lives. So the first Arab, he doesn't even hesitate. He blurts out the first practical thing that comes to mind. Give me a donkey. And poof, just like that, a donkey appears. It's a simple wish, an easy wish, and it's granted immediately. He asked for what he knew, what was right there in front of him.
Now this is where it gets interesting. The next 2 guys see what just happened, and you can see the wheels turning. They're thinking, whoa, wait a minute, I can do better than that.
So the second guy asks for 10 donkeys, and the third, seeing the pattern, he goes even bigger. He asks for the whole shebang, a full caravan, 100 camels, tents, servants, the works. Their ambition is growing right before our eyes.
But the fourth Arab, he takes it to a completely different level. See, he doesn't just want things anymore. He wants a whole new reality. Make me a king, he says. And boom, he's got a crown on his head, a palace, gardens stretching out as far as you can see. He didn't ask for donkeys, he asked for a kingdom. But the fifth Arab, oh boy, he sees that kingdom, and he decides he's not going to make the mistake of asking for too little. He decides to ask for the entire universe. Make me Allah, he demands. And in a flash, he's thrown right back onto the sand, naked and covered in sores. He didn't just ask for too much, he overreached completely. So, the moral of the story seems pretty clear, right? Ask for little, you get little. Ask for much, you get much. Ask for way too much, and you lose it all. But here's the real twist, the part that matters for us. The source material argues that most of us are in absolutely no danger of asking to be made into a law. No, we make the exact same mistake as that first Arab. We consistently, almost automatically ask for just one donkey. And nowhere is this one donkey mindset more common, more ingrained than in the world of investing. It's actually been turned into one of the most popular and maybe one of the most damaging pieces of advice you'll ever hear. And there it is. You'll never go broke taking a profit. Gosh, it sounds so safe, doesn't it? So smart. It sounds like a guaranteed way to avoid losing. But in reality, it's the financial equivalent of asking for a single donkey when an entire kingdom is sitting there waiting for you. It's a philosophy of small, timid ambitions. So let's just put these two philosophies side by side. On the left, you've got that one donkey mindset, all about grabbing those small, safe gains. And on the right, you've got the kingdom mindset, which, it operates on a totally different principle. Fortunes are made by buying right and holding on. This isn't about chipping away at little profits. This is about building an empire.
And look, this isn't just some nice idea or a feel-good platitude. It is a formula that has created truly staggering wealth. This is what we're going to call the 100-to-1 formula, and it's the idea that turning, say, $10,000 into $1 million, well, it isn't some fairy tale. It's a documented reality. I want you to just think about this number for a second. 360. Since 1932, more than 360 different stocks have gone up 100 to 1. Let me say that again, 360. This is not some rare win-the-lottery kind of event. It's a documented pattern of opportunity that has shown up again and again and again. Let's just let that sink in for a moment. A $10,000 investment becomes $1 million. And this kind of opportunity was available in 32 different years since 1932. The key? The only requirement wasn't some complex trading scheme or a hot tip. It was just two things. Buy one of the right companies, and then have the patience to simply hold on. Okay, so that's the theory. But how does this actually work in the real world? Let's dig into the stories of people who really did it. These aren't just theories on a page. These are real-life examples of that kingdom mindset in action. So first up, we've got the story of a man the author calls Mr. Blank. His lawyer, just floored by the size of his portfolio, asked him for a secret. How on earth did you do it? And the answer was so simple, it's almost funny. He just said, I never sell anything. He had the patience. He just held on. And then there's a guy named Paul Garrett. He was a former vice president at GM, and at age 64, he was supposed to be retiring. But instead of slowing down, he decided to start a brand new mission, to build a fortune not really for himself, but so he'd have a much greater capacity to help other people. Now, he wasn't just throwing darts overboard. He developed a really clear 4-point checklist to buy right. First, he looked for companies that were small, because, sheer size works against that kind of explosive growth. Second, they had to be relatively unknown so he could get in before all the hype. Third, they needed a unique and essential product. And finally, and this is crucial, they had to have strong, forward-thinking management. And his results? Well, the proof is in the pudding, right? He found this little company called Haloid, which later became Xerox. He bought in at an average of $1 a share. By 1971, it was selling for over $125 a share. He did the same thing with teleprompter. Bought it for 75 cents and watched it soar past $30. He didn't just buy right, he held on. By 1971, even after giving millions away, the market value of what he still held was over $14 million. That's the power of asking for a kingdom. It is really, really hard to argue with $14 million.
But now, for a really important cautionary tale. Let me introduce you to Carl Pettit. An incredibly successful guy, a top-tier financier. Back in 1925, he owned 6,500 shares of a company that would eventually become IBM. And he sold them for over $1 million, which at the time was a massive fortune. He took his profit, he got his donkeys.
So what do you think those same shares would have been worth if he had just held on? $2 billion. Let that sink in. $2 billion. With a B. He made $1 million profit, which cost him $2 billion in potential gains. This might be the single most painful and powerful example of the danger of taking a profit too soon.
Pettit learned two huge lessons from this. Well, $2 billion mistake. First, you stay with your winners as long as the company itself is still strong. And second, always, and I mean always, be aware of who is giving you advice and what their motivation is. Is their interest truly aligned with yours?
So all of this really brings the question right back to us, doesn't it? We've seen the formula, we've heard the stories of incredible success and just unbelievable regret. And it's so easy to listen to all this and think, yeah, that's great for them, but what about me?
And here's the number one objection, the one I hear all the time. But I don't have $10,000 to start with. And you know what? That's a fair question. It feels like you need to be rich just to get in the game. But Andrew Carnegie gave us the real answer a long, long time ago. He said the ultimate question isn't are you rich, but can you save money? Because the journey to wealth, the journey to your own kingdom, it doesn't start with a big pile of cash. It starts with the simple, incredibly powerful habit of saving.
So we end up right back where we started. You've heard the parable. You've seen the proof that fortunes are made not by chasing quick profits, but by buying right and holding on with an insane amount of patience. That angel might be a metaphor, but the opportunity is real. The only question left is, what are you going to ask for? A donkey or a kingdom?
All right, today we're going to dive into a story that honestly sounds more like a fairy tale than a financial strategy. It's called Sinbad's Valley of Diamonds. We're going to dig into the source material that uncovers these almost mythical 100-to-1 stock market winners that, believe it or not, popped up during one of the darkest economic times in history.
So I want you to picture this. The year is 1932. We're in the absolute depths of the Great Depression. Things are bleak, and a Wall Street old-timer says this to the offer. Anyone who can put his hands on $10,000 to invest at these prices is a rich man. It sounds completely nuts, doesn't it? But as we're about to find out, this wasn't just some crazy talk. It was literally the map to a hidden treasure.
Okay, here's our game plan for today. We'll kick things off with the idea of a lost fortune, then look at some of the mind-boggling winners in hindsight. We'll try to figure out if there was some secret formula for finding them. Then we'll get into that age-old debate, market timing versus stock selection. We'll see that this wasn't a one-time thing, and we'll wrap it all up with the big lesson, buy right and hold on.
First up, a lost fortune. Our story starts in 1932, and the whole point here is to look at this incredibly grim period through a completely different lens.
So, forget what you think you know about the market in 32. It wasn't just a graveyard of wealth. The author wants us to see it as a valley, a field just littered with financial diamonds. Now, for the very, very few who had the cash and, frankly, the guts, this wasn't a time of ruin. It was a once-in-a-generation shot to build staggering wealth from a pretty small initial stake.
So how staggering are we talking? Let's take a look at some of the returns that actually came out of this period. Let's call it the 100-to-1 club.
I mean, just look at these numbers. They're almost hard to process. If you put 10 grand into Eastman Kodak in 1932, it could have become over $1.4 million. Goodyear Tire, over $1 million. And get this, Sears Roebuck would have turned that $10,000 into nearly $2.5 million. I mean, that's not just a great return. That's life-changing, generational wealth.
And you got to understand, this wasn't some one-year lightning-in-a-bottle situation that only happened in 32. The opportunity kept going. The very next year, in 1933, you could have found similar massive winners in companies like Melville Shoe, Newmont Mining, and Philip Morris. This Valley of Diamonds was open for business for a while.
All right, so this is where it gets real. It's easy for us to sit here decades later and talk about this, but the real question, the million-dollar question, is how could anyone have possibly known to pick these stocks back then? Was there some kind of magic formula, some secret code you could crack?
Well, this is where it starts to get really puzzling.
Let's put two of those monster winners side by side. You had Eastman Kodak. In 1932, it was actually making money. Its stock was holding up better than the rest of the market. It looked, relatively strong. But then you had Goodyear. It was losing money, a lot of it, and its stock was getting absolutely crushed. It looked weak as could be. And yet, they both went on to become 100-to-1 winners. How does that work?
Okay, let's make it even more confusing. Let's look at valuation. The price-to-earnings ratio, a basic way to see if a stock is cheap or expensive. Melville Shoe was trading at just over 5 times its earnings. By any standard, that's a cheap stock, a classic value investment. But then you look at Newmont Mining, another huge winner, trading at 21 times its earnings. It looked expensive, especially for that time. So again, you've got two completely opposite profiles leading to the exact same incredible outcome.
And this table right here just drives the point home. It absolutely demolishes any simple rule you might try to create. Look at the PE ratios. Two of the biggest winners, Goodyear and Sears, didn't even have a PE ratio because they were losing money. It was incalculable. Newmont looked expensive, Kodak was somewhere in the middle, and Melville looked cheap. There was no pattern. No single metric could have pointed you to all of these future giants. The code, it turns out, was not so easy to crack.
Okay, so if the fundamentals were kind of all over the place, if looking at the books didn't give you a clear roadmap, maybe the secret wasn't what you bought, but when you bought it, right? Maybe it was all about timing the market perfectly.
And this really gets us to the great debate, the one investors have been having for 100 years. If the numbers themselves don't give you the answer, is the real key to wealth just nailing the market's ups and downs? Is it all about timing? Now, to answer this, the author tells a pretty amazing personal story. In 1937, he was on the front page of the Wall Street Journal, and he called it. He correctly predicted the coming bear market, writing that the major trend was downward. And you know what? He was 100% right. He timed the market perfectly.
But, and this is the incredible part, this quote gets to the very soul of this whole story. He later wrote this: "I would have been much better off if instead of correctly forecasting a bear market, I had focused my attention throughout the decline on finding stocks that would turn $10,000 into $1 million. Just think about that. Even with perfect market timing, he realized he was focused on the wrong thing. He was playing the wrong game."
And if you need one more example to really slam this point home, just look at the story of Sharp and Dome. You could have bought shares in this future 100-bagger for a bargain price, not just in 1 year, but in each of 12 consecutive years, from 1932 all the way to 1943. And get this, you could add the worst possible timing, buying at the absolute peak price in 6 of those years, and still made a 100-to-1 return. It's just a knockout blow for the idea of selection over timing. Finding the right company was so much more important than finding the right day.
So this brings us to the next big question, because I'm sure you're thinking, okay, fine, this worked during the Great Depression, but that was a completely unique, once-in-a-lifetime event, right? Well, was it? As you can see from this timeline, these 100-bagger opportunities, they didn't just disappear after the 30s. They kept popping up. In 36, PepsiCo. In 38, Beach Aircraft. 42, Sharing Plow. 45, 3M. Even as late as 1948, Motorola. That Valley of Diamonds wasn't someplace you could only visit in 1932. It was a reoccurring feature of the market for anyone who knew what to look for.
In fact, the source makes this absolutely stunning point about the company that became PepsiCo. It says that investors had to basically actively try to miss the opportunity. For 7 straight years, they had to turn their backs on it. The opportunity wasn't just knocking on the door, it was practically kicking it down. These weren't fleeting moments. They were long, persistent trends. So, we've kind of dismantled the whole idea of a simple, one-size-fits-all formula. And we've seen that even perfect market timing wasn't the golden ticket. Which brings us, finally, to the author's simple but incredibly powerful final lesson.
The fundamental thesis is this: the way to wealth is to buy right and hold on. That's it. It's not about complex charts. It's not about frantic trading. It's not about trying to outsmart the entire market's next move. It's about finding a great company and then having the discipline and the patience to just stay with it.
And that really leaves us with something to think about, doesn't it? I mean, this lesson comes from a very different era. Today, we live in a world of 24/7 financial news. We can trade stocks on our phones in a split second, and there's this constant pressure to always be doing something. So in our world today, what does it truly mean to buy right? And maybe even more important, what does it really take to just hold on?
All right, let's dive right into one of the biggest paradoxes in all of investing. We're going to talk about hunting for elephants. And what I mean by that are those incredibly rare, absolutely life-changing stocks, the ones that can return $100 for every single dollar you put in.
So that brings us to the big question, right? Over the decades, the market has produced hundreds of these monster companies, these absolute giants. Why is it that so few people, and I'm talking even the professionals, ever actually managed to catch one? Well, the answer, as we're about to see, has very little to do with picking the perfect stock and almost everything to do with psychology and, you guessed it, patience.
You know, the author of the book we're looking at today learned this lesson not on Wall Street, but of all places, hunting elephants in Africa. The rule on the safari was dead simple. If you're out there looking for an elephant and you fire your rifle at some small bird, a guinea hen, well, the noise is going to scare away any elephant from miles around. Your hunt for the big prize is over for the day. And that one single idea is the key to everything we're about to unpack.
So let's talk about what these guinea hens actually are in the world of investing. We're going to break down the psychological traps that make us miss out on the elephants because we're too busy chasing these small, distracting little profits.
This right here, this explains the whole game. On one side, you've got the guinea hen hunter. You know this person. They're jumping in and out of trades, always chasing the latest hot tip, hoping to scalp a quick, small gain. And then, on the other side, you have the elephant hunter. They are looking for one, maybe two truly great companies to just buy and then hold on to for years, maybe even decades, letting that incredible power of compounding do all the heavy lifting for them.
I love this analogy. Think about a fish. It sees the shiny lures spinning through the water, and its brain just goes, hey, the last thing I ate was moving, so this must be food too. And you know what? We investors do the exact same thing. We see a stock price rocketing up, and our instinct kicks in. The last stock I bought was going up, so this must be a good one. It's a really dangerous reflex that makes us value simple motion over actual fundamental substance.
Okay, now this next idea, it's a tough one to swallow for a lot of people. The author makes this incredible claim that every time you sell a stock, it's basically a confession of error. You're admitting you were wrong. You're admitting you didn't have the conviction, the belief to hold on for that truly massive long-term win. Selling for a quick 20% profit is just admitting you settled for the guinea hen.
And here's where our own brains just work against us. It's kind of crazy, right? Our behavior makes no sense. As a shopper, if a TV you've been wanting goes on sale for 30% off, you get excited. You think, wow, what a great deal. But as an investor, when a great company you own goes on sale, meaning the stock price drops 30%, we panic and we sell it. We are literally hardwired to do the exact opposite of what we need to do to succeed in the long run.
Now, these psychological traps we fall into are made so much worse by all these myths that get passed around on Wall Street. You know the old saying, it ain't what you don't know that gets you into trouble. It's what you know for sure that just ain't so.
Let's start with the biggest myth of them all. This is the one everybody believes. When things get rocky, we run to the safety of cash. But I gotta ask, is it really safe?
Just look at this number for a second. 50 to 70%. What that number means is that's the historical loss in the purchasing power of the US dollar over any 100-year period you want to pick, going all the way back to 1820. That slow, silent killer called inflation means that holding cash over the long term is a guaranteed loss. It is the absolute opposite of safe.
And the second great myth is this obsession with avoiding failure at all costs. We become so terrified of picking a loser, so scared of making a mistake, that we become totally paralyzed. And instead of seizing a great opportunity, we just do nothing.
And the math behind this whole elephant hunting idea, it's just incredible. Think about this. If you bought 100 different stocks and 99 of them, 99, went completely to zero, became totally worthless, but just one of them was a 100-to-1 winner, you'd get all of your original money back. This completely flips risk on its head. The biggest risk isn't picking a few losers. The biggest risk is missing out on that one enormous winner.
Okay, this brings us to what our author calls the single most expensive mistake an investor can ever make. And it's not what you think. It isn't buying the wrong stock. It's selling the right one way, way too early.
Just let these numbers sink in for a minute. Back in 1921, somebody sold their shares in this little company for about $21,000. I'm sure they were happy, probably made a nice little profit. But 50 years later, that company was called IBM, and that exact same stake was worth over $150 million. That is the gut-wrenching, catastrophic cost of selling too soon.
And this chart shows you why that happens. It's all about the magic of compounding. the vast majority of the profit, it comes at the very, very end. So for a stock to go up 100 times over 25 years, you might get a 40 times return in the first 20 years, which is fantastic. But the other 60 times, most of your profit piles on in just those last 5 years. If you sell out in year 20, you leave the biggest part of the prize on the table.
So why on earth do we sell? Well, it's often for reasons that have absolutely nothing to do with the business itself. We sell because the price just feels too high, or for some tax reason, or, because we're just bored and the stock isn't doing anything. These aren't rational decisions. They're emotional reactions, and boy, are they costly.
Now, this all sounds really good in theory, right? But did this stuff actually happen in the real world? Well, let's take a look at the anatomy of some of these true 100-baggers and see where this incredible patience really paid off.
Take a look at this list. These weren't some obscure, hidden companies that nobody had ever heard of. These opportunities were brought to the public by the biggest names on Wall Street: Merrill Lynch, Goldman Sachs, Lehman Brothers. The elephants were right there, hiding in plain sight.
Let's just take one example. Pfizer. Imagine it's 1942, and a salesman convinces you to buy 100 shares. Your total cost for the whole thing would have been just under $2,500.
So what happened? Well, by 1971, that little investment had multiplied a staggering 141 times over. It turned less than $2,500 into almost $350,000. And all the investor had to do was buy it and then do absolutely nothing for 30 years. And that, my friends, is the impossibly hard part.
Okay, here's an even better example of patience. Somebody invests $10,000 into a company called General American Oil back in 1937. Now, this was not some glamorous, exciting stock. And worse, they bought it right on the eve of a nasty bear market. I mean, this looks like a complete recipe for disaster.
And this is the most important lesson of all. For 16 straight years, the stock did worse than the overall market average. Can you even imagine the psychological torture of that? The immense pressure to sell, to just give up and buy something else that was actually working. But for the very few who managed to hold on, that initial $10,000 investment was worth over $1.2 million by 1971. Just incredible.
So, when you boil it all down, what does this all mean for us today? Well, the core philosophy is stunningly simple, even if it's unbelievably difficult to actually do. Find the right kind of company, buy it, and then find the inner fortitude to hold on, through thick and thin, for the long haul.
And that brings us to this final, critical question, a question you really have to ask yourself. The author says that self-deception is the worst kind of deception, because we're the ones doing it to ourselves. So you have to be brutally honest. When you look at how you invest, at what you're actually doing, are you patiently setting yourself up to hunt for elephants? Or are you just out there in the noise, chasing the quick movements of guinea hens? The answer to that question could really make all the difference.
You know, what if I told you the secret to making an absolute fortune isn't about chasing the next hot trend? What if it's about finding the things everyone else has decided are worthless and thrown in the trash? Well, that's what we're diving into today. A really powerful, kind of counterintuitive way of thinking that's all about learning to swim against the current, especially when the rest of the world is just rushing towards a cliff. So here's the game plan. First, I'm going to hit you with a number so huge you'll think it's a typo. Then, we're going to unpack the simple principle that makes a number like that even possible. We'll look at two incredible real-world examples from way back when. After that, we'll talk about the kind of mindset, the kind of guts you need to actually pull this off. And we'll wrap up with the biggest question of all. How do we even begin to apply this stuff today? All right, let's get right into it. Section 1, a 4,000 to 1 opportunity. We're talking about a fortune that was literally built from scraps nobody wanted. And it all kicks off with one absolutely mind-blowing number. 4,274 times your money. I'll just let that sink in for a second. That's not a percent gain, that's a multiplier. To put that in perspective, if you had put in just $100, it would have turned into over $400,000. Now, your first question is probably what on earth did that? But the real question, the deeper one, is how can a situation that creates a return like that even exist in the first place? And here's the answer. It came from the financial trash heap, defaulted bonds, basically an IOU from a company that had gone bust and couldn't pay its bills. This wasn't some hot tech startup. It wasn't a world-changing invention. It was a piece of paper that pretty much everyone on Wall Street considered completely worthless, bought during the absolute darkest days of the Great Depression. This is the very definition of buying what no one, and I mean no one, else wants. Section 2, when lemmings flee. So this brings us to the core idea, the whole philosophy behind this. We're talking about the contrarian principle. See, these unbelievable opportunities, they don't just pop up every day. They only appear when you have the nerve to stop, turn around, and walk away from the panic's crowd as they're all stampeding in the same direction. And it really comes down to the kind of questions you ask. The crowd, they're obsessed with what's happening right now. They're asking, how much profit is this company making today? They chase whatever's popular, whatever's in the news. But the contrarian asks a totally different question. Forget the profits for a minute. What does this company actually own? It's like ignoring a kid's bad report card for the semester and instead asking about the value of the entire school building. And that's because good assets, we're talking factories, land, patents, real stuff, they represent potential. They have real-world value that doesn't just evaporate because a company is having a bad year or, in these cases, a really, really bad decade. The bet the contrarian is making is that sooner or later, that potential can be unlocked, and they get to buy all that future potential for pennies on the dollar while everyone else is freaking out about today's losses. All right, Section 3, Old Ben Cole. Let's look at how this plays out in the real world. Because theory is one thing, but this is how you actually find gold in an industry everyone else has written off as dead. So try to picture the 1930s. Oil was brand new. It was cheap, like 10 cents a barrel cheap, and it was easy. Every expert, every analyst was convinced that coal was finished, done, obsolete. As if that wasn't bad enough, you had powerful unions putting the squeeze on whatever tiny profits were left. To any normal investor, this industry was an absolute, undeniable disaster zone. Now look at this timeline. This was not a quick flip. This was a 40-year marathon. It starts in 32 by picking up a $1,000 IOU for just $60. A few years go by, the company gets reorganized, and you get some new bonds plus actual shares of the company. A decade passes. The new bonds get paid back in full with interest. Then the stock splits. And finally, almost 40 years later, the whole company gets bought by an oil giant. This is the definition of playing the long game. And what was the payoff for that nearly 40-year journey? That $60, it became over $15,000, a 262 times return. And it all started with a bet on an industry that the rest of the world had quite literally left for dead. Okay, Section 4, H.K. Porter. Now, if you thought a 262 times return was wild, well, that was just the warm-up act. The story of the H.K. Porter Company is even more extreme, even more unbelievable. So let's start with a realistic all-in cost. Back in 1932, a $1,000 defaulted bond from this company might have been listed at, say, $50. But to actually get a hold of one, you might have had to offer double that. Then tack on maybe $5 in fees for the lawyers. So let's just say your real-world cost to get in the game was $105. So how in the world did that single piece of paper turn into a fortune? Well, it happened through a series of corporate moves that just kept multiplying the ownership over and over again. First, the bond got swapped for stock. Then, bam, a massive 30-for-1 split. A few years later, another 4-for-1 split. Through all these reorganizations and stock splits over decades, that one initial holding just exploded, ballooning into more than 19,000 shares of the company. And at their peak, in 1971, what were those 19,000 shares worth? Almost $500,000 from a $105 investment. That, right there, is the 4,274 times return we started with. It's just the incredible power of buying valuable things for next to nothing and then letting time and corporate finance work their magic. Okay, Section 5, Vision, Courage, and Patience. Now, this all sounds amazing on paper, but the source material is crystal clear on this point. This is not a math problem. You can't just solve this on a spreadsheet. It is, first and foremost, a test of your character. And success depends entirely on what the author calls the 3 key contrarian virtues. These are the 3 pillars. First, you need vision, the ability to look at a worthless company and see something nobody else does, the valuable assets, the hidden potential. Second, you need courage, the guts to actually pull the trigger and buy when every headline is screaming doom and every expert is calling you an idiot. And third, and this is probably the hardest one of all, you need patience, the ability to just hold on, not for a few months, but for decades, through wars, recessions, and long, lonely stretches of doubt. And just to hammer home how incredibly rare this kind of patience is, the author quotes this really old-fashioned saying, "Patience is a virtue, have it if you can. Seldom found in women, never found in man." Now look, obviously the language is a bit dated, but his point is that the people who can defy that cynical little rhyme, that tiny fraction of people who have this profound, almost inhuman patience, they're the only ones who ever manage to pull off these kinds of incredible results. So, on to our last section, finding your next time. What do we do with these amazing stories from almost 100 years ago? I mean, the goal here isn't to perfectly copy them. It's to understand the core lessons, the timeless principles, so that we can spot our own opportunities right here, right now. So our final takeaway really boils down to these three things. First, you have to deliberately go against the crowd. You have to seek out what's unpopular, what's feared, what everyone else is desperately trying to get rid of. Second, you have to train your brain to look past today's earnings report and focus on the balance sheet. What does this company actually own that has real lasting value? And third, you have to accept that this is a psychological game more than anything else. You have to actively work on developing that vision, that courage, and most of all, that unbelievable, almost supernatural level of patience. And that brings us to the final and most important question. These stories are from a completely different era. The economy, the technology, it's all changed. But human nature, our tendency to get swept up in fear and greed, that hasn't changed one bit. So the challenge for you, for all of us, is to look at the world today and ask, what is the modern-day coal mine? Where are the really good assets that everyone has given up on? If you can find the answer to that, you might just find your very own next time. Thanks for joining me. All right, welcome to The Explainer. Today, we're going to talk about an idea that kind of turns everything you think you know about investing on its head. What if I told you the real secret to those massive, life-changing returns isn't about being a genius who can predict the future? What if it's about something way simpler, but also way, way harder? So let's just start with this wild idea, right? It flies in the face of everything you hear on TV about active trading. Getting in, getting out, timing the market. What if the single most profitable thing an investor can do, for years, maybe even for decades, is to just sit on their hands and do nothing at all? Okay, so this really boils down to a battle between two big ideas. On one side, you've got what our source material calls foresight. Trying to be a prophet, predicting a company's every move, the market's every wiggle. And on the other side, you've got tenacity, which is just a fancy way of saying being stubborn as a mule and holding on for dear life. We're all taught that to win, you got to be the smartest person in the room. You have to see what's coming around the corner before anyone else. But the stuff we're digging into today suggests that might be a total myth when you're talking about building real generational wealth. The real key might be something else entirely. So let's see how this actually works in the real world. We're going to look at some stories where holding on wasn't some peaceful, patient wait. No. It was about surviving a full-on, white-knuckle roller coaster ride that was designed to shake everybody out. Okay, so take a look at this company, Automatic Data Processing. Talk about a test of faith. Just try to put yourself in those shoes for a second. You buy in and then, bam. In just over a year, 70% of your money is just gone. Poof! Everyone, and I mean everyone, would be screaming at you to sell and cut your losses. But the few people who had the stomach to hold on through that pain, wow, 156-to-1 return. It's just staggering. So if you thought that last one was cuff, you might want to buckle up, because this next story about Occidental Petroleum, it makes that ADP story look like a walk in the park. We're not talking about one bad year. We are talking about a multi-decade journey through the investment desert. Just try to wrap your head around this. You put $10,000 into this company in 1932. Then, for the next 9 years, while the rest of the market is roaring back, the Dow is up more than 10 times from its low, your investment does the exact opposite. It withers away, shrinking down to just $1,600. You would be absolutely kicking yourself thinking you'd made the worst financial decision of your life. But here is the punchline, and it is a heck of a punchline. That measly $1,600, that symbol of your failure, by 1971, it had exploded into more than $3.3 million. Can you believe that? There's just no way anyone on Earth could have predicted that outcome. That's not foresight. That is pure uncut tenacity. And that gets us to another really crucial idea. The biggest home runs, they don't always come from companies that just perfectly execute on their 5-year plan. Sometimes they come from companies that morph into something so completely different, so unexpected, that nobody, not even the folks running the show, could have seen it coming. Check this out. This is how the big shots at Moody's described a company called Haloid way back in 1933. Produces and markets photographic paper exclusively. I mean, you can practically feel yourself falling asleep just reading it, right? So boring. There is zero, and I mean zero, hint that this little paper company was about to become Xerox and completely change every office on the planet. The future wasn't just hard to predict. It literally hadn't been invented yet. And look, this wasn't an overnight thing. It was this long, winding, unpredictable road. Haloid was just selling paper for years before it even got near a photocopier machine. Then you've got this other company, Ogden Corp. Same idea. It started life as a utility company of all things, and then decades later it completely pivots into pharmaceuticals. It's messy. It is not a clean, straight line to success. So, trying to use foresight here, it would have been totally useless. I mean, honestly, who could have possibly predicted that? Who would have said, you know that utility company? Yeah, I bet they get into the birth control pill business, and it's gonna be huge. Nobody. It's impossible. The only thing you could have done was believe in the people running the company and just hang on tight through a complete identity crisis. Right, so this next part is really fascinating. Sometimes the biggest opportunities, they're not in some complex, futuristic tech. They're hiding in plain sight, in simple, everyday products that the market just ignores because they're not cool or fashionable. Just listen to the language they used to describe Tampax back in 1943, a catamenial device. Wow. You can just feel how uncomfortable they were even writing that down. And that was the whole point. The social taboos were so strong back then that serious, hard-headed investors just dismissed the company out of hand. They thought, there's no way they'll ever be able to advertise that. And that cultural blind spot, that's where the incredible opportunity was hiding. And this table, it just lays it all out, plain as day. A $10,000 investment in 1941, if you timed it perfectly at the low, turned into over $14 million. But here's the real kicker. Even if your timing was terrible, I mean, you bought at the absolute high for the year, you'd still have made over $7 million. Heck, if you were 7 years late to the party and bought in 1948, you'd still be a millionaire. The timing just wasn't the main event. So we've looked at tech, at oil, at consumer goods, all these totally different businesses. What's the one lesson that ties all of these incredible stories together? Let's boil it all down to the one big, powerful idea from our source material. Here it is. This one sentence says it all. What one buys in the stock market is much more important than when he buys it. I mean, that's really it. All the energy, all the stress, all the charts we stare at trying to get in at the perfect moment, it's a sideshow. The main event, the only thing that truly matters in the long run, is picking the right company in the first place. And if you need one more piece of proof, this tri-continental example is perfect. You could buy their riskier warrants, and you had this massive 8-year window to buy in and still get a 100-to-1 return. Or you could buy their safer common stock, where you needed to be a psychic and buy on one specific day in 1941 to get that same result. The choice of what you bought was so much more important, so much more forgiving than when you bought it. Just think about that for a second. With those warrants, your timing could have been sloppy, completely imperfect, and you still could have become a millionaire. Getting the timing absolutely perfect, well, that just turned your $1 million into $23 million. It was a bonus, a spectacular bonus, but still just a bonus. As the source so beautifully puts it, it was just gilding the lily of opportunity. And this brings us to my absolute favorite phrase from this whole analysis: triumphs of lethargy. Isn't that just perfect? It completely flips the script on what we think of as good investing. It suggests that inaction, that what looks like laziness, can actually be a financial superpower. It's the genius of getting out of the way and just letting a great company do its thing. So I'll leave you with this one question to chew on. Is your temperament really suited for this? Because what this all suggests is that the hardest part isn't the intellectual homework of finding a great business. The hardest part is the emotional strength it takes to just sit there and do nothing, year after year, while the world screams at you to do something. Do you have the patience for a triumph of lethargy? That's something to think about. Thanks for joining this explainer.
You know, what if I told you that the most powerful, most profitable investment decision you could ever possibly make is, well, to do absolutely nothing? I know, it flies in the face of everything we're told about the markets, right? The constant buying, the frantic selling, the need to always be ahead of the curve. But today, we're going to dive into some truly incredible stories that prove that sometimes inaction is the ultimate power move.
It sounds almost ridiculous, doesn't it? The idea that once you've made a smart purchase, the absolute best thing to do is just sit on your hands. It's such a simple concept, but honestly, in practice, it's one of the hardest things for any of us to do. I mean, with the news cycle hitting you 24/7 and the constant temptation to chase the next hot stock, doing nothing feels wrong. So let's dig into why it might be so right.
So let's break down these two different worlds. Over here, you've got the adrenaline rush of trading. You know what I'm talking about. That little dopamine hit from a quick win, constantly watching the charts, the feeling that you're doing something. It feels productive. But then there's this other path. It's much quieter. It's the wisdom of just holding on. And this strategy lets you sidestep all those killer commissions and taxes. And most importantly, it unlocks the almost magical force of compounding. It's really the difference between playing a slot machine and planting an oak tree.
And this right here is the core philosophy we're talking about today. It's this idea that once you've made a solid choice, your work is pretty much done. But here's the real kicker. What happens when your timing is just awful? What if you buy something and it immediately tanks? That's where these stories go from just interesting to totally mind-blowing.
Okay, let's kick things off with a classic, the story of Globe and Rutgers Fire Insurance Company. This is a tale that starts with a stock and absolute freefall, a satirical newspaper, and what seemed like a really, really bad joke.
Now this quote here, it might look like some heartfelt company slogan, but it is pure 100% sarcasm. See, this wasn't from the Wall Street Journal, but from a parody paper they used to put out called the Ball Street Journal. In 1933, this was a punchline. It was how Wall Street insiders were laughing at a company whose stock had been so completely destroyed it had become a running gag.
And this timeline just lays out the sheer catastrophe. Look at this. In 1932, the stock's flying high at $257. A year later, after the crash, it's plunged to under $3. Now just imagine you read that joke ad and you think, okay, I'll buy in at around 65. You'd feel like you got a steal off the highs, right? But then, it gets so much worse. For the next 9 years, you just watch it bleed out, all the way down to $5 a share. It is almost impossible to imagine worse timing.
So here it is, the million-dollar question. Common sense tells you this investor got completely wiped out. I mean, they bought a stock that was already crashing and then held it as it fell another 90%. They should have lost everything. But what if, against every shred of logic and reason, they just did nothing?
It's almost unbelievable, but that's what happened. That hypothetical $10,000 investment, the one you made based on a joke, the one that immediately plummeted, if you just held on through all that pain, would have grown into $488,000 by 1971. That is a 48 times return on what was, objectively, a horrifically timed purchase. I mean, wow.
And look, this wasn't just a hypothetical for some small-time investor. Check out the difference between two professional firms. Tricontinental Corporation, one of these so-called smart money investment trusts, sold its massive stake. That one decision cost them over $144 million in future gains. Meanwhile, CV Star & Company, they held on, and their block of shares grew to be worth a staggering $160 million. The cost of doing something was immense.
So, that first story was all about surviving just terrible timing. Our second story, about a company called Curlin Oil, is about something a little different. It's the idea that you don't actually have to be the first one to a great idea. Sometimes a life-changing opportunity will knock on your door more than once.
You can see right here, opportunity literally knocked 3 separate times. First, there's an initial offering, then a second one, a year later at a slightly higher price. But look at this. Years later, after all the early excitement had faded and investors got bored and moved on to the next shiny thing, you could have bought in on the open market for even less than the original price. The party wasn't over. People had just forgotten about it.
But just like with Globe and Rutgers, this was no easy ride. If you had bought in on that very first offering, you would have had to go through the gut-wrenching experience of watching your $10,000 investment get cut by more than half over the next 5 years. Most people would have sold, right? Kicking themselves for making a terrible mistake.
And this is where it gets just fascinating. Hundreds of ordinary people had this incredible fortune right there in their grasp. The only thing they had to do was nothing, just weather the storm and fight that urge to panic sell. So what was the reward for that kind of incredible patience?
An almost unbelievable fortune.
For the folks who bought at the absolute bottom in 1940, a $10,000 investment turned into over $3 million. And even the early investors, the ones who had to sit through that 50% drop, they still saw their money grow to $1.7 million. The reward for simply not selling was literally life-changing.
All right, this brings us to our final and, I think, most dramatic case study. If you thought those first two stories were a test of will, the story of Richfield Oil's bonds, well, that's the final exam. This is the ultimate example of holding on through what looked like certain doom.
Okay, so the setup here is absolutely critical. We're not talking about speculative stocks anymore. These were bonds. People thought they were making the safest investment you could possibly make, paying just under face value for a bond from a major oil company. They weren't gambling. They were being prudent.
And then the floor just fell out. Richfield Oil went bankrupt. And as you can see, that safe $990 investment completely cratered. At its lowest point, that bond was worth just $40. Over 95% of its value, just gone, wiped out.
No, seriously, put yourself in their shoes for a second. Your safe money has evaporated. The company is officially bankrupt. Every single fiber of your being is screaming at you to sell, to just get something back before it goes to zero. Holding on looks like pure insanity. So, what do you do?
For the very few who somehow, against all odds, managed to just hold on through the bankruptcy, the result was simply staggering. After the company was reorganized, each one of those worthless-looking bonds was converted into stock. And by 1971, that stock was worth nearly $13,000. I mean, think about that. From a low of $40 all the way to $13,000. That's a financial roller coaster like no other.
So just let this sink in for a second. Even the people who bought these bonds right before the crash, with the absolute worst timing you could possibly imagine, and simply refused to sell, they saw their initial investment of $990 grow to nearly 13 grand. They multiplied their capital 13 times by holding on through a total collapse.
So, after hearing these wild stories, what's the big lesson here? Are they just relics from some bygone era? Not at all. They're much more than that. They're what you might call a lamp of experience, a bright light from the past that can show us the way forward, especially when we're all tempted to hit that panic button during the next market downturn.
You know, when you put it all together, the lessons are just crystal clear. Real wealth isn't built in some flurry of constant activity, but in the quiet discipline of avoiding it. It's about having the guts to see past the short-term panic and volatility, knowing that patience can even fix atrocious timing. And by simply holding on, you sidestep that death by 1,000 cuts from fees, from taxes, and from your own emotional impulses.
You know, the source material for this brings up this fantastic quote from Patrick Henry, and it just perfectly frames why all this matters. This isn't just looking backwards and saying, oh, wouldn't that have been nice? It's about using that lamp of experience, using the clear and sometimes really painful lessons from the past to light our own path forward so we can make better decisions in the future.
And so, that's where we're left. We're left with this really powerful idea. History has basically handed us a map to potential fortune. It's not a complicated map, but it is an incredibly difficult one to follow because it requires us to fight our own worst instincts every step of the way. The real question isn't whether the map is accurate. It's whether we have the courage and the patience to stay the course when the journey gets rough.
Okay, let's dive into a powerful and honestly, a pretty painful lesson in investing. It's all about the allure of what looks like unstoppable growth and a very costly mistake that even the smartest people make when they fall in love with a stock's past.
So, let me ask you something. I want you to picture the perfect stock. You know, a real champion, the kind of company that just seems to defy gravity, delivering incredible returns year after year, almost like clockwork. What would that even look like on a chart?
Well, here's a chart of a company just like that. For 15 solid years, it crushed the general market. It's funny, whenever I show this chart to people, without telling them the name, they almost always guess it's some famous tech giant from our time. A Xerox, an Apple, a Google. I mean, it just has that unmistakable look of a world beater, right?
And this is what made it so incredible. In the good times, when the market was flying high, this stock went up even more. And in the bad times, when the market tanked, this stock still went down, sure, but it fell less. So you got bigger gains and smaller losses. Honestly, what more could you possibly ask for as an investor? It's the dream, isn't it?
So, what was this incredible, seemingly unstoppable company? Any last guesses?
American Can. Yeah, I'm guessing that wasn't the name on the tip of your tongue. A manufacturer of, metal containers. And it's right here, in this huge gap between what we expect and what the reality was, that our story gets really, really interesting. Because here is the unbelievable twist. After that spectacular 15-year run, anyone who bought American Can stock at its high point and just held on, well, they saw basically zero price gain for the next 35 years. A full generation of absolute stagnation. Just let that sink in. An entire career, a whole lifetime of market cycles, and an investment that went absolutely nowhere. What on earth happened? To really get how this star performer just completely flatlined, we have to look at a fundamental danger in investing. It's the high price of popularity, and it's the trap of assuming the past is just going to repeat itself forever and ever and ever.
It all starts with this key metric called the price-to-earnings ratio, or the PE ratio. The easiest way to think about it is like an expectation meter, or maybe a hype meter. A high PE means the market is incredibly optimistic, and it's expecting massive growth. A low one means, well, expectations are a lot more down to earth.
And by 1936, after that amazing 15-year run, investors were absolutely euphoric about American Can. I mean, they were so confident in its future that they were willing to pay a 50% premium for its earnings compared to other top companies. They were pricing it for absolute perfection.
And this right here, this gets to the very heart of the mistake they made. They weren't really paying for the company's future. They were paying a huge premium for its past. They were driving by looking in the rearview mirror. Investors saw that incredible 15-year track record and basically bet everything that the next 15 years would be an exact copy.
But as the source material so brilliantly puts it, you can't buy the past. It's not for sale. That past performance, well, that's already owned by someone else. They're the ones who made that money. When you buy a stock, you are making one bet and one bet only, a bet on the unknown future. Every single dollar you invest is a vote of confidence in what's going to happen, not what already did.
And for American Can, well, that unknown future looked very, very different. New, hungrier competitors jumped into the market. The entire food industry got turned upside down by the invention of frozen foods, which needed totally different packaging. And then came the ultimate disruptor for a can company: plastic. None of this was obvious in 1935, but it completely changed the game.
So the crucial point here is that even the absolute best companies can become Cinderellas at the ball. The most beautiful carriage, the most dominant position in the market, it can all turn back into a pumpkin if you stay too long without paying attention to how the world is changing around you.
So, what's the takeaway? Does this mean the whole idea of buy and hold investing is a myth? That you should just be constantly jumping in and out of stocks? Not at all. In fact, let's look at a fascinating counterexample that really shows the other side of this coin. Okay, now consider Avon products. An investor who put just $10,000 into Avon back in 1955 would have had over $1 million by 1971. And get this, if they'd gotten in just a bit earlier in 1948, that same 10 grand would have ballooned to nearly $10 million. I mean, those are just staggering, life-changing returns. But here's the kicker. Somebody, somewhere, bought those shares at those low prices. But the real tragedy, as the source material points out, is how few of them actually had the stomach, the conviction, to hold on through all the market's ups and downs to actually see those gains. Living through the fear and the doubt, that's the real test, isn't it?
And this is the key distinction we have to make. The advice to buy right and hold on is not a recommendation for blind faith. It's not about buying a stock, shoving the certificate in a drawer, and forgetting about it for 30 years. No, it's an argument against constantly churning your portfolio, unproductive trading. True success demands eternal vigilance. You have to constantly reevaluate and make sure the reasons you bought a company in the first place still hold true.
And you need that vigilance because every single company, no matter how great it is subject to one simple, powerful, and totally unbreakable law of both nature and the markets. And here it is. This is the central idea of this whole explainer. The tree does not grow to the sky. No matter how strong the trunk is or how deep the roots go, no growth, not in nature, not in business, can just keep rocketing upward forever. Eventually, gravity always wins.
And if you don't believe it, the simple math makes this crystal clear.
Just take a successful company with $1 billion in sales today. Now imagine it somehow managed to grow at 20% a year for 50 years. Its annual sales would be over $9 trillion. That's a figure larger than the entire economy of most countries on Earth. It's mathematically and logically impossible. The world isn't big enough.
So when you pay that huge premium for a stock, like those investors did for American Can, you're not just betting that its incredible growth will continue. You're actually betting that it will continue even after the company gets 3, 4, or 5 times bigger, which gets harder and harder to do. You're betting that this one single tree will finally be the one that grows to the sky.
And all of this leads us to the final, crucial question you have to ask yourself as an investor. Are you paying for a company's glorious past, which is already in the history books? Or are you trying to think like a chess master, one move ahead of everybody else, looking at the board not as it is right now, but as it will be? Because that right there is the difference between buying yesterday's news and owning tomorrow's winner. You know, every time you buy a stock, you're not just buying a little piece of a company. What you're really doing is stepping into an argument. It's an argument about the future. And on the other side of that trade, there is somebody just as smart, just as informed, and just as convinced that they're right as you are. So, how do you make sure you're the one who wins that argument? Just think about this for a second. Every single trade that happens is a head-on collision of two completely opposite points of view. The buyer is looking at this stock and seeing a bargain, a fantastic future, explosive growth right around the corner. But the seller? They're looking at the exact same company, at the exact same price, at the exact same moment in time, and they see the total opposite. They see a peak, slowing growth, a future that's already played out. It's fascinating, right? One person's golden opportunity is another person's escape hatch.
And this is the central mystery of the whole thing, isn't it? We're not talking about some rookie trader versus a Wall Street pro here. A lot of the time, both the buyer and the seller are incredibly smart, well-informed people. So how on earth do they look at the same set of facts and come to completely opposite decisions? Well, that's the big question we're going to dig into and try to answer right now.
Okay, so here's our game plan. First, we're going to tear down this idea of the infallible expert. Then, we're going to tackle the illusion that if you just get more information, you'll make better decisions. After that, we'll get into the real tools you need, understanding risk and playing the odds. And finally, we'll talk about how to turn all those raw facts into real, actionable wisdom. First up, expert opinions. We're all conditioned to trust them, right? The head of the big bank, the seasoned analyst on TV, the company insider. We assume they know what they're talking about. But when it comes to predicting the future, trusting the experts can be, well, let's just say it can be a spectacularly bad idea.
Just take a look at this quote and really pay attention to the timing and the source. This wasn't some random guy on the street. This was the head of the world's largest bank in the fall of 1929. The market had just been absolutely hammered, and the official word from the very top of the financial world was, "Don't worry, it's just a healthy correction. We're about to roar back."
But here's what that healthy correction actually turned into. Yeah, there was a little fake-out rally in 1930, but then the bottom just fell out. The market didn't just fall, it was obliterated, hitting a low of 41. And that 200 level he was so calm about, it took 17 long years for the Dow to even see that number again. So much for onward and upward.
Or how about this one from the same time? U.S. Steel was a J.P. Morgan company through and through. Nobody on the planet knew more about that company than the House of Morgan. So when you have a Morgan broker on the floor of the stock exchange, very publicly bidding $190 a share for huge blocks of the stock, well, that's got to be the ultimate seal of approval, right? The smartest money in the room is buying big.
And the result of that expert bet? By 1932, you could pick up that same U.S. Steel stock for just over $21. That's a drop of almost 90%. So the most informed, most confident opinion in the world turned out to be one of the most catastrophically wrong bets you could have made.
And for our last example, this is the ultimate insider. Picture this. John D. Rockefeller himself, the guy who basically invented the oil industry, steps out in front of the press and announces that he and his son are personally placing an order to buy 1 million shares of his own company. You just can't get a stronger, more public statement of confidence than that.
And what happened? The stock popped up for a little bit, and then it just kept sliding, all the way down to $20 a share. The lesson here is just so powerful. Not even the founder, with all his money, all his power, and all his knowledge, could stop the market's fall. And you have to understand, these men weren't trying to trick anyone.
They were sincere. They truly believed they were right. They were just wrong, profoundly wrong.
So what's the big lesson we can pull from all this? It's actually pretty simple, but it's crucial. Opinions by themselves are worthless. What you really need to look for are the reasons behind the opinions. What are the assumptions that opinion is built on? Because at the end of the day, nobody, and I mean nobody, has a crystal ball. The future is, and it always will be, a mystery.
Okay, so that brings us to the next big trap. This very tempting idea that if we could just get all the information, every last fact and figure, then we'd be guaranteed to make the right call. But you know what? That's just another illusion.
Here's the reality of why two super-informed people can disagree. First, they're working with different assumptions. They both read the exact same earnings report, but one assumes that growth is about to take off, while the other assumes it's about to hit a wall. Second, it might not even be about the stock itself. The seller might actually like the company, but just thinks they found an even better place to park their money. And third, nobody's knowledge is ever perfect. The person who is 99% informed might come to a completely different conclusion than someone who's 98% informed. That tiny 1% gap can change absolutely everything.
And if you don't believe me, listen to this quote. This is from Joseph P. Kennedy, the very first chairman of the SEC, the guy they hired to police Wall Street. He said, "If I had all the money that has been lost on inside information, I'd really be rich." That's just devastating. He's saying that so-called sure things and inside tips have probably cost people more money than they've ever made them. Why? Because it gives you this false sense of certainty in a world where there is none. So you have to realize that information isn't some magic bullet. It's just raw material, and its value disappears incredibly fast. You have to learn to grade it. Is the news you're hearing actually fresh, what we'd call golden news that the market hasn't priced in yet, or is it silver, kind of known, already having some impact? Or, and this is the worst, is it lead? Stale, old news that everybody already knows. Acting on lead information is like trying to get rich off of yesterday's newspaper. It's just not going to happen.
Okay, so if we can't blindly trust the experts, and we can't ever really have all the information, what in the world are we supposed to do? Well, this is where we have to change the game we're playing entirely. We have to stop looking for certainty, and we need to start thinking like a professional card player, in terms of risk and in terms of odds.
This is the single biggest mental shift you have to make. You have to accept, deep down, that you will never be certain about the future. It's impossible. But once you let go of that ghost, you can finally focus on what is possible, weighing the probabilities. You stop asking, will this company succeed? And you start asking the real questions. What are the odds of success? And does the current price reflect those odds? Is the potential reward big enough to justify the potential risk? That is the only game worth playing.
The legendary investor Hardwick Tyers put it perfectly. Risk isn't something you should try to avoid at all costs. It's a required ingredient for success. Taking a loss every now and then isn't a sign that you failed. It's an expected cost of doing business, just like paying rent for an office. It's a cost you have to be willing to pay if you want a shot at a real, meaningful gain. If you avoid all risk, you guarantee you will have zero reward.
And this gets us to the true art of speculation. And let me be clear, I'm not talking about reckless gambling or just betting on a long shot. Real speculation is a skill. It's the ability to see risk more clearly than the rest of the market does. It's about finding those situations where everybody else is panicking about something that isn't actually a real threat, or when they're massively overestimating a real risk. That fear is what pushes the price down and creates a genuine opportunity for you.
These two analogies nail the point perfectly. In the card game bridge, if you go an entire night without ever failing to make your bid, that's actually a bad sign. It means you're not bidding aggressively enough. You're leaving points on the table. It's the same thing for a bank manager. If a bank has a record of 0 loan losses, they're not a hero. They're a bad manager who has been turning away good, profitable loans because they were too scared of risk. A perfect record is almost always a sign of a flawed, overly timid strategy.
Okay, so let's put all the pieces together. We've busted the myth of the experts. We've thrown out the illusion of complete information. We've embraced risk and odds as our real toolkit. So what's the final step? It's about turning all of that raw stuff into something much, much more valuable.
I love this quote from one of the early publishers of the Wall Street Journal. The fact without the truth is false. A single fact all by itself can be totally misleading. For example, a fact might be, Company X missed its earnings target. Okay, but the truth might be, Company X missed its earnings target because it was spending a ton of money on a new product that's about to completely dominate its industry. You see? The real value, the real work, is connecting the dots. It's seeing how this fact relates to that trend and how it all fits into the bigger picture. That's where you find the truth.
And that's really the ultimate takeaway here. Collecting facts is easy, that's just the price of admission. The real work begins after you've read all the news, after you put the paper down. It's that quiet, thoughtful process of taking all that information, all those probabilities and odds, and calmly shaping them into sound judgment. It's about sitting back and thinking, okay, based on everything I know and everything I don't know, what is the wisest course of action? The goal is not to be the most informed person in the room, the goal is to be the wisest.
And so, after all of this, I want to leave you with one critical question. And this doesn't just apply to investing, it applies to any big decision you make in your life. Stop focusing so much on what other people think and stop the endless hunt for just one more piece of data. Instead, turn that question inward and ask yourself, what are the core, unspoken assumptions that I'm making about the future? Because that, right there, is where the argument is truly won or lost.
All right, let's talk about something we've all felt. You click the buy button on a stock, and that little question pops into your head. Is this a smart, calculated move, or am I just pulling the lever on a slot machine? Today, we're going to break down a framework that helps you shift from pure gambling to making probability-driven decisions. We're going to learn how to read the market's collective mind and start figuring out the real odds. So here's our game plan. First, we'll reframe how we think about investing. Less like a casino, more like a game of odds. Then, we'll learn the language the market uses to shout its expectations from the rooftops. After that, I'm going to show you a really powerful tool I call the hope thermometer. We'll see it in action by taking apart a legendary market winner. And then, at the very end, we'll walk through exactly how you can calculate it for yourself. Okay, Section 1, Investing, a Game of Odds. Let's tackle the big question right out of the gate. When you put your money in, is your success all about your brilliant analysis? Or is it just dumb luck? Figuring this out is really the first step in graduating from a gambler to a true investor. I mean, really think about it. The comparison is so easy to make, right? You place your bet, you hope for the best, you've got the flashing numbers, that thrill when you win, that pit in your stomach when you lose. It feels just like a casino. But is that really the whole picture? You know, this reminds me of this great old story. A poker player gets hauled in for illegal gambling. His defense? Poker isn't a game of chance, it's a game of skill. And to prove it, he plays against his accusers all night and, well, wins everything they have. See, to an amateur, poker looks like random luck. But to a pro, it's all about skill, reading the other players, and most importantly, understanding the odds. The stock market is exactly the same. The pros consistently win because they understand the probabilities better than almost everyone else at the table. So here's the bottom line. The goal isn't to find some mythical sure thing, because those don't exist. The real trick is to find those situations where the scales are tipped way in your favor, where you're making a bet that has a much higher chance of paying off than the market currently believes. Okay, on to Section 2, the language of expectations. So if our goal is to find those favorable odds, we first have to figure out what the market is already thinking. We've got to learn how to decode its collective mindset. Now, this sounds completely impossible, right? I mean, how on earth can you read the collective mind of millions of individual investors, all buying and selling for their own reasons? It seems like total chaos. But it turns out there's a surprisingly simple logic that cuts right through all that noise. It really all comes down to 3 basic ideas. First, a stock's value today is all about the cash it's expected to spit out in the future. Pretty simple. Second, a dollar of profit from, say, Apple is worth the same as a dollar of profit from Ford. A dollar is a dollar. And third, and this one is the real kicker, if people are willing to pay a whole lot more for that dollar of profit from Apple than from Ford, they're making a loud and clear statement. They're telling you they expect Apple's profits to grow way faster in the future. And this quote from Robert G. Wees just nails it. A stock's price isn't just some random number. It is a physical measurement of anticipation. When you see different prices, you're really seeing different expectations for the future. The market is constantly broadcasting its predictions. You just have to learn how to listen. And you can see this playing out on a massive scale when you just compare stocks to bonds. A few decades ago, the market was incredibly pessimistic. People demanded 3 times the payout from stocks as from safe bonds just to own them. They were betting on a future of declining profits. Now, fast forward to more recent times, and it completely flipped. Bond yields were almost double stock yields. That means investors were so optimistic about future growth that they were willing to accept a tiny payout today because they were pricing in a future of booming profits. It's a huge psychological pendulum. So that's the big picture. But how do we bring this down from the entire market to just one single stock? Well, for that, we need a specific tool, and that's what we're going to call the hope thermometer. The standard tool Wall Street uses for this is the price-to-earnings ratio, or PE ratio. It's really simple. It's just the price of a stock divided by its earnings over the last year. Basically, it tells you how many dollars you have to pay to get just $1 of that company's current profits. So if a stock is $100 and it earns $5 a share, its PE is 20. Simple as that. But here's the thing. A PE of 20 by itself doesn't tell you a whole lot. Is that high? Is that low? The magic happens when you compare it to the overall market, and that's the relative PE ratio. This, my friends, is our hope thermometer. It tells you exactly how much more or less hope is baked into your stock compared to the average company. Let's make this real with a classic example. Polaroid back in its glory days. At one point, its relative PE was 4. You can see it right here on the chart. That means investors were willing to pay 4 times as much for $1 of Polaroid's earnings as they were for $1 from the average, big, boring Dow Jones company. Just think about the expectation that's built into that number. It means the market was betting that Polaroid's earnings would have to quadruple just to be considered fairly priced against the rest of the market. That is a massive amount of hope. Now, and this is absolutely crucial, this hope thermometer is not a magic crystal ball. It's not a buy or sell signal. Think of it like when a doctor takes your temperature. A high fever doesn't tell the doctor exactly what illness you have, but it's the first and most vital sign that something is wrong and needs a closer look. Our thermometer does the same thing. A high reading tells you that you're paying for perfection, and any little slip-up could be a big problem. It's a warning sign that says, hey, you better dig deeper here. Okay, section 4, anatomy of a winner. So let's see how this all comes together in the real world. We're going to dissect a massive winner, Avon Products, to see how the two engines of a stock's price, the actual business results and the market psychology, work together. Avon was an absolute monster of a stock. It returned 100 times the initial investment. But when you break down that incredible performance, you see two very different stories. The first row, rising relative earnings, that's the business story. The company was a runaway success. Its profits grew way faster than the average company. But now look at that second row, the rising relative PE. That's the psychology story. As the business took off, investors got more and more excited, and they were willing to pay a higher and higher price for those earnings. And get this, that psychological shift accounted for almost half of the stock's total mind-blowing gain. The lessons here are so important. First, never, ever underestimate the power of psychology. A shift in perception can be just as powerful as a shift in profits. Second, always remember that what goes up on a wave of hope can come crashing down on a wave of doubt. And maybe most importantly, when you buy a stock with a really high hope thermometer reading, you need to understand that the optimism is already public knowledge. The easy money from just getting more popular is gone. From that point on, future gains have to come almost entirely from the business hitting it out of the park. I mean, look at this simple math. It's so powerful. To get a 100-bagger like Avon, you don't need the earnings to go up 100 times. If the business's earnings grow by 25 times and the market gets 4 times more optimistic about those earnings, bam! You're at a 100-fold return. It's that 1-2 punch of reality plus psychology that creates these legendary winners. All right, we've covered the theory, we've looked at the history. Now it's time to make this completely practical. In this last section, I'm going to walk you through, step by step, exactly how to calculate the hope thermometer for any stock you want. Don't worry, this is a super simple 5-step process. First, find the stock's current price. That's the easy one. Second, find its earnings per share for the last 12 months. You can get this on pretty much any major financial website. Third, do the division. Price divided by earnings. That's the stock's PE ratio. Fourth, find the PE for the overall market. Something like the Dow Jones average PE is usually published in the Wall Street Journal. And finally, step 5, just divide your stock's PE by the Dow's PE. And that's it. That's your number. So what does that final number actually tell you? That's your hope thermometer reading. It's a single, powerful number that tells you the story. If the result is 2, it means the market is paying twice as much for each dollar your company earns compared to the average blue chip. If it's 0.5, it means the market is pessimistic and only paying half as much. You now have a concrete number that measures the market's hidden expectations. And that really brings us back to the whole point of this. Look, we can't ever completely eliminate guesswork when we're investing. We're trying to predict the future, after all. But we can stop treating it like a casino. We can arm ourselves with tools like this to make sure we're making an informed guess, not just a wild one. And right there, that's the difference between gambling and investing. So I'm going to leave you with a challenge. Take a look at your own portfolio. Grab the stocks you own and run through these 5 simple steps. Calculate the hope thermometer reading for your own companies. What story is the market telling you? Are you paying for deep pessimism, or are you paying for a future that's already priced for perfection? Knowing the answer to that question is the first and maybe the most important step to truly figuring out the odds. You know, there's this one number that investors, well, we all tend to obsess over. It's a simple ratio that promises to tell you if a stock is a bargain or a bust. But what if I told you that relying on that one number is one of the most dangerous delusions in all of finance? Today, we're going to pull back the curtain on something called earnings quality to see how a company's profits can be, well, a carefully constructed illusion. Let's get into it. Now, that is a powerful statement. The price-to-earnings ratio, the PE ratio, it's everywhere, right? It's supposed to be this quick and dirty way to see if a stock is cheap, but our source material here calls its blind acceptance one of the worst delusions in investing. So why the harsh words? Well, it's because the entire concept rests on a really shaky, fundamentally flawed assumption. And this analogy, it just perfectly illustrates the absurdity of it all. This sign, it adds up completely unrelated numbers to get a totally meaningless total. I mean, 3 years, 2 wounds, 4 children. You can't just add those things together. It makes no sense. The argument here is that this is exactly what we do when we blindly compare PE ratios. We're adding up apples and oranges and, wrenches, and calling the total 17. We assume $1 of earnings from company A is the same as $1 from company B. And as we're about to see, that is a very dangerous mistake to make. This really is the critical question for all of us, isn't it? Even really sophisticated investors, people who should know better, they'll talk about earnings quality. But then, when it comes down to it, they just default to using these simple statistical comparisons that completely ignore the very thing they were talking about. It's a classic case of knowing the right thing to do, but taking a shortcut that leads you right off a cliff. Today, we're getting off that path for good. So here's our game plan for today. First up, we're going to dissect the dangerous delusion of the PE ratio itself. Then we'll put on our detective hats and uncover the accounting smokescreen. From there, we'll go beyond the bottom line to understand what earnings truly represent. Then we'll look at factors that are more than just numbers. And finally, we are going to buckle up with the investor's seatbelt to help safeguard your investments. All right, let's jump right into our first section, a dangerous delusion. We're going to get right to the heart of the problem with these PE ratios. And here it is, laid out plain and simple. The fallacy is that we assume earnings are as comparable as prices. Think about it. A stock price is a stock price. A $10 bill in New York is the same as a $10 bill in California. It's a hard, comparable number. But $1 of earnings? Oh, that is a soft, squishy, malleable figure, shaped by dozens of accounting choices, business strategies, and all sorts of hidden liabilities. They are absolutely not the same. Now, to really understand this, we need to look at it from 2 different angles. First, there's the accounting approach. This is like being a detective, right? You're searching for clues and hidden information in the financial reports. Then there's the conceptual approach. This is more like being a philosopher, asking, what does $1 of earnings truly represent in terms of future value? We are going to tackle both. All right, time for the detective work. In section 2, we're heading straight into the accounting smokescreen. I'm going to tell you a simple story about 3 companies that reveals just how easily the numbers can be manipulated to hide what's really going on. Okay, here's the setup. We've got 3 identical companies. Each one starts with $100 million and earns a solid 20% before taxes. All 3 want to expand. So Company 1, they play it safe and just issue new stock. Company 2 takes on some debt by selling bonds, all out in the open where everyone can see it. But Company 3 gets clever. It uses something called lease financing, which is kind of like renting its new assets. Now here's the trick. This obligation often doesn't show up as traditional debt on the main financial statements. It's hidden away in the fine print. Now have a look at what happens when business is good. Just follow that apparent return on equity column. Company 1, with no leverage, no debt, earns a straightforward 10%. Makes sense. Company 2 uses debt, and that leverage juices its return up to 16%. Investors can see the risk, and they can see the reward. But now look at Company 3. Its hidden leverage makes it look like it's earning a fantastic 15%, so it seems almost as good as Company 2, but without any of that obvious debt on its books. This looks like the perfect situation, right? But this is where the illusion just shatters. When a downturn hits and those pre-tax earnings fall all the way to just 5%, the reality of that hidden leverage comes roaring into view. Company 1's return drops, sure, but it's stable at 2.5%. Company 2's drops even more, down to 1%, but this was predictable given its debt. And here's the punchline. Company 3 gets completely wiped out. Its return on equity plummets to 0. Those hidden lease payments are a fixed cost, just like debt, and in a downturn, they devour every last penny of profit. That, my friends, is the accounting smokescreen in action. So we've seen how accounting can create a pretty thick smokescreen. Now let's shift gears. In Section 3, we're going beyond the bottom line to look at something a bit more subtle, but just as important, the conceptual value of a dollar of earnings. This is such a profound question. So companies earn profits. They pay some out as dividends, and the rest, the retained earnings, get plowed back into the business. We just assume those retained earnings are creating value, that they're a good thing. But what if they aren't? What if a company is spending all that money just to tread water, just to stay in the same place, adding nothing to its future growth? In that case, those retained earnings are conceptually closer to an expense. It's just money spent to maintain the status quo. From a growth perspective, they're essentially worthless. Let's make this a little more concrete. Take a look at Company A and Company B. Now, on the surface, they look like twins. Same earnings, same dividend. But the real story is in their sales trends. Company A is growing, while Company B is shrinking. So how can their earnings be the same? Well, it implies that Company B must be doing something unsustainable to prop up its numbers. Maybe they're selling off assets or slashing vital expenses. Company A's earnings come from real organic growth. Company B's are just a facade. That dollar of earnings from Company A is clearly, without a doubt, of higher quality. Okay, let's add one more layer to this. We've got two more companies, X and Y, with identical reported earnings. But Company X is spending $1 per share every single year on research and development, while Company Y spends absolutely nothing. Now, you might think that makes Company Y's earnings better, but it's the opposite. Company X's earnings are higher quality for two big reasons. First, there's a chance their R&D leads to a breakthrough that creates enormous future value. And second, they have the option to cut that R&D spending to immediately boost their reported profits if they ever get into a tight spot. Company Y has neither that amazing potential nor that flexibility. So, you see, this whole concept of quality goes way beyond just the finance department and R&D budgets. In this next section, we're going to zoom out a bit to see how it's really more than just numbers. It's about seeing the full, complete picture of a business. A single dollar of reported earnings can hide a multitude of sins. You have to ask yourself, is the company stuffing its warehouses full of product it can't sell? Is it polluting the environment, just kicking a massive future cleanup bill down the road? Is it driving away its best and brightest people with a toxic culture? All of these things, they degrade the true quality of its earnings, no matter what that pretty bottom line number says today. So, after all this, how do we protect ourselves from all of this financial trickery? Well, that brings us to our final and, frankly, our most important section, the investor's seatbelt, your personal safeguard against deception. I just love this metaphor. It's perfect. Most of the time, you drive your car and you don't need your seatbelt. And most of the time, you can probably get away with a quick, superficial look at a company's earnings. But that one time you don't, the consequences can be catastrophic. Paying scrupulous attention to earnings quality, that is your financial seatbelt. It's the discipline that will save your fortune when the unexpected finally happens. So, what are the practical steps you can take? First, you've got to scrutinize those reports. Dig in. This is where you would have found the hidden lease obligations of Company 3, buried deep in the footnotes. Look for those red flags we talked about, like inventories or receivables that are just ballooning. Second, read the financial press. Good journalists are often the first ones to sniff out this kind of gimmickry. And third, and this is probably the most important rule of all, if you see a management team that consistently plays these games, just walk away. The best defense is to not play at all with people who lack integrity. So I'll leave you with this one thought. The next time you see that bottom line earnings number, I want you to just pause for a second and ask yourself, what am I really seeing here? Is this a dollar that was earned from sustainable growth and real innovation? Or is it a dollar that was manufactured through accounting tricks that are mortgaging the company's future? The answer to that question can make all the difference. Thanks for joining me.
All right, let's jump right in. We're going to talk about something that feels, well, a little old school, right? Stock market manipulation. You hear about it in old movies, stories from the Roaring '20s. But here's the thing. Is it really just a story, or is it more relevant today than we think? We're going to dig into the timeless principles behind it and see if it's really a thing of the past.
So, this is the big question, isn't it? I mean, we've got the SEC, the Securities and Exchange Commission. They're the sheriffs of Wall Street, right? They've been on the beat for decades, supposedly hunting down the bad guys. So with this powerful watchdog in place, you'd think market manipulation would be, well, extinct. But is it?
You know, to really get why we're still talking about this, we have to rewind the clock, way back. We're talking about Charles H. Dow. Yeah, that Dow, co-founder of the Wall Street Journal. And he said something pretty striking. He basically said the market is always being manipulated, more or less. To him, it wasn't some rare event. It was just part of how the market works. So this isn't some new paranoia. This concern is baked into the very foundation of the market.
Okay, so here's how we're going to tackle this. First up, is manipulation just a ghost story? Then, we'll look at the investor's greatest weakness, what makes us vulnerable. After that, we'll get into the 3 main arts of manipulation, and finally, we'll talk about how you can see through the whole illusion. Let's get into it.
All right, Section 1, manipulation, a ghost story. Let's look at the regulations versus the reality.
So, look, the law is pretty black and white on this. For over 35 years, the SEC has officially outlawed manipulation. They prosecute people for it. On paper, this should be a done deal. Case closed. We've got the rules, we've got the cops. So, why are we still talking about it? What's the disconnect?
Well, here's a pretty powerful way to think about it. It's an old saying. You expect to find cockroaches in a dirty kitchen. Why? Because the food they live on is there. The argument is that the stock market is kind of the same. As long as there's a ton of money to be made by manipulating things, it's just common sense to assume someone is going to be trying to do it. The opportunity itself is the bait.
So that brings us right to our next point. If these manipulators are like lions, what are they hunting? What's the fuel for their engine? Let's talk about the investor's greatest weakness.
And here it is, the core mistake. This was pointed out over 100 years ago, and it's maybe more true today than ever. The biggest error the public makes is paying attention to prices instead of to values. Think about that. We get mesmerized by the ticker tape, the little green and red numbers flashing on the screen, instead of asking the real question, what is this business actually worth?
And this really breaks down the 2 different worlds, right? When you're obsessed with price, your decisions are all emotional. You're just reacting to the noise, chasing what's hot. And what does that lead to? Buying high and selling low, the classic trap. But if you focus on value, it's a whole different game. You're making rational decisions based on what the business is actually doing. You're looking for bargains. You're aiming to buy low and sell high. It's a completely different mindset.
This price obsession leads to what might be the most common mistake in all of investing. I love this metaphor. It's like shooting where the rabbit was. Just picture it. You see a rabbit, it bolts, and you shoot at the empty space where it used to be. That's what happens when you buy a stock after it's already had a huge run-up. You're too late. The rabbit is gone. You're just reacting to what already happened, not what's going to happen.
And this gets into the really weird psychology of the market, which is totally backward compared to anything else in life. Think about it. It's actually easier for us to believe a stock is a good deal when its price is high and going up. It feels safe, right? Everyone else is buying. But when a price is low, it feels scary, risky. And the manipulators? Oh, they know this inside and out. They know that in the stock market, if you want to attract a crowd of buyers, the craziest thing is you mark the price up.
Okay, so we get the weakness, we get the psychology. Now, how do the manipulators actually pull it off? Let's get into the mechanics of the unseen engine.
So historically, it boils down to 3 main techniques. First, you push prices down on purpose so you can buy up shares for cheap. Second, you abuse inside information, especially around big deals like mergers. And the third one, this is the real masterpiece. You manipulate the company's earnings.
And this table shows the game in action. It's the old Rothschild principle. Look at the 2 columns. When everyone else is panicking and selling, what's the manipulator doing? They're buying. They're picking up valuable stuff for pennies on the dollar. And then, when the public gets excited and starts buying like crazy as prices go up, who do you think is selling to them at that high price? The manipulator. It's a perfect flip. It's a transfer of wealth, plain and simple, from the emotional crowd to the cool-headed operator.
But here's a really key point.
The smartest players don't just try to force a stock price up and down. That's amateur hour. It's too obvious, too messy. No, the real art, the real genius is in manipulating the story. And what's the most important chapter in any company's story? The earnings report. If you can control that number, you control how people see the company's value. The stock price just follows the story you write.
Okay, let's look at a classic example from the 1920s with the railroads. It's a masterclass in this stuff. So, step 1. A new crew takes over a railroad, and they announce this huge, expensive maintenance plan. Sounds responsible, right? But then, step 2. All that spending crushes the earnings report. The profits look terrible, and the stock price tanks. And what happens next? Step 3. While everyone else is panicking, the insiders are quietly scooping up shares at rock-bottom prices. Then, the magic trick. Step 4. They announce the maintenance is finished. All those big costs are gone. So what happens in step 5? The next earnings report comes out and wow, the profits have surged. The stock price goes to the moon. And the insiders cash out. See how it works? It's a perfectly orchestrated play, all using accounting that looks totally above board.
So, this all brings us to the most important question, really. What do you do about it? Knowing all this is one thing, but how can you, as an investor, actually protect yourself? How do you see through the illusion?
And the answer isn't just trust the SEC. Look, regulators are important, but they can't be everywhere at once. The real defense, the ultimate shield, isn't external, it's internal. It's all about developing your own critical thinking. It's about learning not to take every single headline at face value.
This is the guiding principle right here, from Clarence Barron. The fact without the truth is false. Think about that for a second. A fact can be totally accurate on its own, but if it's presented without context, it can paint a completely false picture. So a headline says, company earnings plunge. That's a fact. But the truth might be they plunged because the company just spent $1 billion building a new factory that's going to triple their profits next year. You have to connect the dots. You have to find the truth behind the fact.
So let's put this into practice. Imagine you see a really nasty story about a stock, just terrible news. But here's the thing. The stock has already fallen by like 80%. A critical thinker doesn't just read the headline and panic. You have to ask the most important question. Why is this story coming out now? This bad news isn't really news. Somebody knew about it for months. So why is it being blasted on the front page today after the price has already crashed? Could it be that someone wants to shake out the last few people holding on so they can buy those shares for cheap?
And listen, this isn't necessarily about bad reporters. Even the best journalists can be used. Someone with an agenda gives them a juicy tip, a scoop, and they report it. The information is released for a reason, at a specific time. And that's why at the end of the day, you can't let anyone else do your thinking for you. You have to be the final judge. You have to decide what it all really means.
Which brings us to this final thought. It's a powerful analogy that sums the whole thing up. In Africa, where there are no antelope, there are no lions. Lions need a food source to survive. And it's the same in the market. Manipulators can only exist as long as there's a herd of gullible investors to prey on. People who chase price, who panic, who don't think critically. So the real takeaway, the really provocative idea here, is that the power to make the lines disappear doesn't just lie with the regulators. It lies with the antelope.
You ever stop to think about what's happening on Wall Street every single day? Millions of trades, and behind every last one of them is a fundamental disagreement. You got a buyer who's convinced the price is going up, and a seller who's just as sure it's headed down. Now, they can't both be right. And that basic conflict, that duel of opinions, is what makes the whole market tick. It really makes you wonder, though, how do you figure out which side of that bet you should be on? So here's how we're going to tackle that. We're going to start by diving right into Wall Street's biggest argument, this clash of two totally different philosophies. Then we'll look at why they should probably be friends instead of enemies. We'll even get our hands on some of their tools for cutting through all the static and figuring out what the market is actually thinking. And that's all going to lead us to the biggest question of all. What's the real endgame for an investor anyway? All right, let's kick things off with that central conflict. And I mean, this isn't just some casual disagreement over lunch. This is a deep philosophical split on the right way to even think about investing. And over the years, it's basically created two warring tribes on the street. So here they are, the two big camps. First, you've got the fundamentalists. We'll call them the brains. These are the folks who are buried in spreadsheets, digging through financial statements, trying to figure out the true intrinsic value of a company. They ask, what should this thing be worth? Then you've got the technicians. We'll call them the charts. They have a different take. They believe all that fundamental stuff is already reflected in the stock price. So for them, the only thing that matters is studying the price action itself, the patterns, the trends, the psychology of the market. They're asking, what is the market actually doing right now? Now, for as long as I can remember, these two groups have been at each other's throats. But the author of our source material, a guy who spent more than 40 years with a foot in both camps, he makes this incredibly powerful case that, you know what? This whole war is pointless. It's a false choice. You shouldn't have to pick a side. You should be using both sets of tools. In that quote right there, that's the whole ballgame. He's so clear about this. Looking at charts isn't a shortcut to get out of doing your homework on a company. No way. Instead, it's like a second, vital source of intelligence. You could think of it like this. Fundamental analysis tells you what should be happening with a stock, but technical analysis, well, that tells you what is happening, and you really, really need to know both. So why is looking at a chart so valuable, especially if you're a brains person? Well, for one, if your research says buy, but the chart looks like it's falling off a cliff, that's a huge red flag. It might be screaming that you've missed something important. Second, it's all about timing. Are you the brilliant genius who discovered this company first, or are you the last person to show up to the party? A chart can help you answer that. And finally, a chart shows you the unvarnished truth of what people are doing with their actual money, not just what they're saying on TV. As the author puts it, you don't want to be the hunter who sees elephant tracks going straight up the side of a barn and just keeps on tracking. This brings us to this great little concept, the price-proof seesaw. It's a super important market dynamic. See, the market pays a premium for certainty. When you buy a stock when the story is still a little fuzzy and the proof isn't all there yet, you get it cheap. But by the time the good news is on the front page of the newspaper and the proof is undeniable, well, the price is already way up here. Charts can help you see exactly where you are on that seesaw. Okay, so let's get practical. How do we actually start using these ideas? The first thing we need is a tool to deal with all the noise. I mean, the whole market bobs up and down every day, right? That can easily hide what's really happening with the one company you care about. So how do we filter all that out? Well, the answer is a simple but absolutely brilliant idea called relative price. All it means is, instead of just tracking your stock's price in dollars, you track its price as a percentage of something like the Dow Jones. The author's mentor used to say that working in finance is like trying to do chemistry with dirty test tubes. Well, using relative price is how you clean the test tube. You get rid of all the gunk from the overall market's movement so you can see your one company clearly. Let's see exactly how this works with a real-life historical example, the United Fruit Company. This chart shows its relative price over more than 2 decades. That heavy black line is the stock's performance against the market. And let's be honest, at first glance, it just looks like a mess, right? A totally random, jagged line with no story to tell. But now, watch this. Look what happens when we just draw 2 simple straight lines over that mess. All of a sudden, bam, the picture is crystal clear. You can see what the author calls the awesome persistency of a downtrend that went on for 15 years. And then you can see the exact moment that trend was broken. That right there is the power of filtering out the noise. Okay, so seeing the trend is powerful stuff, but charts can help us dig into something even deeper, something almost invisible, the market's psychology. They can actually help us measure the hope and the fear that's really driving the price. For that, just take a look at this absolute head-scratcher. The case of Union Carbide back in the 50s and 60s. Over a 12-year span, its earnings grew by a phenomenal 146%, crushing the market average. So you think the stock was a rocket ship, right? Nope. The stock price actually fell by 5.5%, while the overall market was soaring. I mean, how on earth is that possible? Seriously, think about that. By every fundamental yardstick, this company was killing it. So why did the people who owned the stock lose money? The entire mystery boils down to one simple word: expectations. See, back in 1955, the market wasn't just hoping for good results from Union Carbide, it was pricing in a miracle. Investors were so wildly optimistic they paid a massive premium for every dollar the company earned. So when the company only delivered incredible growth, the market was somehow disappointed and the stock got punished for it. The author tells this perfect little story about 2 boys on Christmas morning. They both wake up and find the exact same brand new bicycle under the tree. But one boy is absolutely ecstatic, just jumping for joy, because all he expected was a candy cane. The other boy is in tears because he was hoping for a Mustang. The bike is the company's earnings. The reaction? That's the stock price. It's never about the bike itself. It's about the bike compared to what you expected. So if expectations are the real driver, is there some way to, I don't know, see them forming? To decode the market's own language? Well, this brings us to one of the oldest and, I'll admit, most controversial tools in the entire technical toolbox. Now, I know this looks really complicated, but the idea behind it is pretty straightforward. This is what's called a point and figure chart for United Fruit. And the technicians who use these things spotted a classic warning sign here, a pattern called a head and shoulders top. You can see it pretty clearly. There's an initial peak, the left shoulder, then a higher peak, the head, and then a final lower peak, the right shoulder. For a chartist, seeing that formation is like a 5-alarm fire. It's a huge signal that a major drop is coming. But here's where it gets really wild. They don't just spot the pattern. They use a special calculation based on how wide the pattern is to project a precise downside price target. And in this case, for United Fruit, the number that calculation spat out was 14 7/8. Now call it a coincidence, call it voodoo, call it whatever you want. But that's just an incredible fact. A simple calculation based on a price pattern from the early 1950s nailed the stock's exact bottom nearly a decade later. It's pretty amazing. So, we've seen that these technical tools can be kind of spooky in how powerful they are, whether it's for seeing trends, measuring hope and fear, or even making these uncanny predictions. But all of this leads us to the biggest, most important question of all. What are we supposed to do with all this? What's the real point of the game? And this is where the whole discussion gets flipped on its head. The author runs a thought experiment. He says, imagine you were the world's most perfect trader. You used these charts to time United Fruit flawlessly. You sold at the very top, and you bought back in at the exact bottom, over and over. If you did that, you would have turned $10,000 into over $400,000, a fantastic 40-to-1 return. But during that exact same time period, investors who ignored all that trading noise and instead just focused on finding the truly great, game-changing companies of that era saw their money grow by more than 100-fold. And that, right there, is the author's final crucial point. The single biggest danger in getting fascinated by charts isn't that they might be wrong. It's that they are so seductive, they tempt you into playing the short-term trading game. And in doing that, you can completely lose sight of where the real, life-altering money is made, buying the right companies and just holding on. So in the end, this debate isn't about choosing brains or charts. It's just about being an observant investor. It's about using every tool you can find to understand what a business is truly worth and what the rest of the world is thinking about it. Because whether you're taking a random walk through the market or a walk in the woods to watch birds, you're just going to have a lot more fun and see a lot more if you keep your eyes wide open.
You know, they always tell you to learn from experience, right? It's supposed to be the best teacher. But what if that's terrible advice? What if our most powerful, most memorable lessons are actually traps, especially when it comes to our money? That's what we're digging into today, how our own past can sometimes be a very poor teacher for our financial future.
There's this great old saying that just perfectly sums it up. In the stock market, a lot of people shoot where the rabbit was. Think about that for a second. It means we're constantly reacting to what's already happened. We're always fighting the last war, prepping for the last crisis, and making today's decisions based on yesterday's news, all while the real opportunity, the rabbit, has already moved on.
So to really get our heads around this, let's start with a little story. And believe me, it has nothing to do with money, but it has everything to do with how a really painful experience can teach us exactly the wrong lesson.
So this is Prince, and the author describes him as being, and I love this, dumb but not stupid. And like pretty much any creature that loves comfort, Prince figured out that the living room sofa was a whole lot better for napping than the cold, hard floor.
Well, you can probably guess this wasn't exactly great for the sofa. His owners had a rule, and they needed a way to enforce it. So they got a little creative.
Yeah, mousetraps. Now, not to hurt him, just to startle him. When Prince would hop up onto the cushions, the traps would snap shut, giving him a little pinch on what the author calls his soft underbelly. You can imagine it. A yelp, a jump, and message received.
And hey, it worked. Prince started to associate the sofa with that sharp, surprising pain, and he stayed off of it. The lesson was learned. But here's the thing, and this is really the whole point. Did he learn the right lesson?
This is where the story gets really interesting, because Prince's simple mistake is the exact same one we humans make all the time, just in a much more complicated arena. It's really a battle between raw memory and cool-headed reason.
So, take a look at this. Prince's memory, his gut feeling, screamed a very simple lesson. Sofa equals pain. Stay away from the sofa. It's direct, it's emotional, and it's totally wrong. Reason, on the other hand, would have taught the real lesson. Mousetraps equal pain. So, you should avoid the sofa only when the traps are there. You see the difference? He confused the location of the pain with the actual source of the pain.
Okay, so how on earth does a dog on a sofa connect to your portfolio? Well, it's simpler than you think. A big, painful financial loss acts just like that mousetrap. It brands our memory, and it makes us want to avoid the sofa, which is the stock market itself, for years and years. Long after the specific danger, the mousetrap is gone.
Let's look at a really powerful, real-world example of this. It comes from the author's own life, a financial mousetrap that was set during the crash of 1929 and would end up influencing his decisions for decades to come.
So, as a young man, the author gets a taste of easy money. He buys some Southern Railway stock, sells it for a quick profit, and probably feels like an absolute genius. Then, the crash of '29 hits. A few years later, deep into the Great Depression, he sees that same stock, the one he sold for $160, trading for just $8. He thinks, this is it, the bargain of a lifetime.
But the market wasn't even close to being done falling. That stock plunged all the way down to $2.50 a share. He was completely wiped out. And that was the snap of the financial mousetrap. A sharp, unforgettable, searing pain.
And the consequence of that pain was just profound. The lesson he learned wasn't about the specific dangers of buying on margin during a historic, once-in-a-century depression. Nope. The lesson his memory seared into his brain was much, much simpler. Just like Prince's, the stock market equals pain. And that flawed lesson made him overly cautious for the rest of his life.
So how, exactly, did that painful memory cost him millions? Well, the answer lies in the next great opportunity that came his way, just a few years later.
So he makes this absolutely fantastic trade in a company called Aluminum Limited. He gets in super cheap, and by 1937, he sells for a really handsome profit. Then, just a few months later, the stock takes a nosedive, and he feels like a genius. He thinks he's expertly dodged another mousetrap. He took his profits, felt totally vindicated. He learned his lesson, right?
Oh, but this slide reveals the true, staggering cost of that lesson from 1929. That small bar you see, that's the profit he took. And hey, it felt great at the time. But that massive bar right next to it, that's what his shares would have been worth by 1971 if he'd just done nothing. The ghost of that 1929 mousetrap made him sell decades too early.
Let's put a hard number on that. Had he simply held on, his original investment would have grown by almost 700 times. 700. All of that potential wealth just gone. Why? Because he was still reacting to the pain of that Southern Railway trade years earlier. He was shooting where the rabbit was.
So, after all this, after experiencing a catastrophic loss and a colossal missed opportunity, what was the final, ultimate lesson he learned from it all?
He realized that the common wisdom we all hear, buy low, sell high, was actually the real trap. It's a short-term game, trying to time the market, trying to grab a few pennies here and there. The real road to wealth, he found, was much simpler but also much harder. Buy right and hold on. It's not about timing market swings, it's about owning great businesses for the long haul.
And that's the crucial point. Success wasn't about trying to cleverly jump on and off the sofa to avoid the mousetraps. It was about finding a great, comfortable sofa with no traps on it in the first place and just staying there. It's about finding real quality and then having the conviction, the guts, to stick with it through all the market's inevitable ups and downs.
Which leaves us with a final question. And this one's for you. I want you to think about your own financial experiences, the wins and the losses. Are those memories serving as a wise guide for you? Or are they a mousetrap set by a past pain that's keeping you from seeing the real opportunities that are right in front of you today? Thanks for joining me for this explainer.
You know, we hear it all the time, right? We're living in the age of data. The idea is that if we can just collect enough information and pour it into a smart enough algorithm, we can solve pretty much anything, from predicting the stock market to fixing social policy. But what if that whole idea is built on a shaky foundation? What if the things that really run our world can't be put on a spreadsheet at all? All right, so let's just cut right to the chase with a huge question. If computers are getting smarter and smarter every single day, why can't we just hand over the keys? Why won't they eventually be the ones in charge? It's a question that gets right to the heart of what makes our economy tick and, well, what makes us human. I mean, think about it like this. Our ancient ancestors didn't survive because they could do the math on predator to prey ratios. No way. These survived because when all the birds suddenly went silent, they felt this deep, primal fear in their gut and just started running. That's intuition. That's a wisdom that's been around a lot longer than any computer. And this, right here, this lays out the fundamental clash we're talking about today. On one side, you've got the computer's world. Everything's neat and tidy. Fixed variables, rules that don't change, hard data. But on the other side, you have our world, the human world, which runs on a completely different operating system. It's a world of subjective value, laws we can literally rewrite, and rights that only exist because we all agree to defend them. So here's the game plan. We're going to tackle this myth of the all-knowing computer head-on. And we're going to do it by digging into 3 timeless principles, ideas that computers just can't grasp, because they're not about numbers. They're about what we humans want, what we agree on, and where we draw our power from. Let's kick things off with the big one, the most fundamental idea of them all. And this is something that a purely logical machine just can't compute. It's the simple fact that value isn't actually in an object. It's in our heads. This right here, this is our first principle, and honestly, it changes everything. You can calculate the cost of making something down to the tiniest fraction of a cent, but that number, it's basically meaningless. The only thing that gives something value is that somebody, somewhere, wants it. Value is a feeling. It's desire. Now, you've probably heard the fancy economist term for this, demand and supply. But it's so much more than some dry concept from a textbook. It's the engine that drives every market on Earth. It's this constant dance between what we want and how hard it is to get. Okay, this is a fantastic example. Let's talk about air, the single most important thing for our survival. Here on Earth, there's so much of it that it has zero market value. It's free. But imagine a colony on the moon. All of a sudden, that exact same air becomes the most valuable commodity in the universe. The air itself didn't change one bit. The human situation, the context, is what changed everything. And it's the exact same story with water. When it's clean and everywhere, it's practically worthless. But what happens if that abundant water gets polluted? Suddenly, pure water becomes incredibly valuable. A computer just sees H2O. A human sees the difference between what's safe to drink and what's not, and that difference alone can create a billion-dollar industry. And this idea goes even deeper. It's about how we literally transform value. A corn stalk, for example, it has no value to us as food. A computer would just see it as agricultural waste. But we humans realized, hey, we can feed that worthless corn stalk to a cow, and that cow turns it into something we really, really want, a great steak. Value isn't just about what something is, it's about what it can become, to satisfy our desires. And this all boils down to one of the oldest and truest rules in business. You just can't use logic to create desire. You can't tell people what they should want. The most successful businesses in all of history get this. They listen. They figure out what people already want, and then they try to give it to them. That's what it means when we say the customer is king. His desires are the law, and you can't program them. All right, so if value is all in our heads, what about the rules that hold society together? To a computer, those are just fixed lines of code. But for us, there's something very different. And that brings us to principle number 2. It's this simple. Every law, every constitution, every regulation that governs our lives is not set in stone. It's a social agreement. And it's an agreement that's always, always up for renegotiation. Just think about it for a second. We amend constitutions. We scrap international treaties. We argue about and change something as simple as a local zoning ordinance. A computer would have to treat every one of those rules as a permanent fact until it's fed a new file. But we humans understand that they're all just temporary points of agreement, ready to change the moment enough of us want them to. You know, the source material had this fantastic analogy for it. Public opinion is like water. It's fluid, it's powerful, it's always moving. And the law? The law is like ice. It's the same thing, just frozen into a solid temporary shape. It gives us structure for a while, but you apply enough heat, enough public pressure, and that ice is going to melt and reform into something new. A computer can analyze the ice, but it can never predict the thaw. Okay, let's get to our third and, honestly, maybe the most powerful principle. If value is subjective and rules are just agreements, what does that say about something as solid as property rights? This is such a raw and important truth. That piece of paper that says you own your house or that line in a database that says you own stock, it has zero power on its own. It only has value because enough other people agree that it does, and, this is the crucial part, they are willing to collectively defend that agreement. See, a computer might log a transaction on some immutable blockchain and see that as a permanent, unchangeable fact. But it's not. It's not like gravity. It's not a law of physics. It's a social contract. And just like any other contract, it can be broken the moment one side, in this case, society, decides it's not worth upholding anymore. And this chart just nails why that contract holds together or why it falls apart. Imagine a game with a bunch of marbles. If the winner takes a fair share, everyone else is still willing to play again tomorrow and defend the rules. But what if one winner starts taking almost all the marbles, every single time? Well, why on earth would anyone else agree to defend that system? It collapses, because the people who are losing have absolutely no reason to protect it. A sense of fairness is the glue. So, where does this leave us? What's the big takeaway here? It's that if there is some kind of master algorithm running the world, it wasn't written in Python or C++. It's written in human nature. It really boils down to these three simple human truths that a computer will just never get. 1, value comes from what we want. 2, rules come from what we agree to. And 3, rights come from our collective power to defend them. A computer can count and it can calculate, but it can't desire, it can't agree, and it can't band together with others to protect an idea. And here's the bottom line. All the complicated math, all the big data, all the figuring, that's the easy part. That all comes second. And it's totally useless. In fact, it can be downright dangerous if you don't first understand these human principles that the whole system is built on. And this leads to maybe the most practical, hard-hitting piece of advice in the whole thing. If you ever see a company or an industry that's ignoring these truths, a company that thinks it can tell people what to value, that acts like the rules will never change, or that builds a system so lopsided that no one wants to defend it, get out. Sell your stock, because that company is built on a foundation of sand, and it's only a matter of time. So I want to leave you with this question. As we rely more and more on AI and big computers to make our choices for us, what other essential human truths are we in danger of forgetting? Because often, the things that are impossible to measure are the only things that really matter.
All right, let's talk about something that sounds like a contradiction, right? Profits in ethics. The big question we're diving into today is this. Can doing the right thing actually make you more money in the long run? We're going to explore this idea that a company's moral compass, well, it isn't just a nice to have. It might be its most powerful weapon for success. So let's jump right in.
I love this quote. He profits most who serves best. I mean, that one line, it basically sums up everything we're about to unpack. It completely flips the script on how we usually think about profit, doesn't it? The idea here is that real, sustainable success, it's not about what you can take, it's about what you can give. It's about genuinely serving people. And that right there is a massive shift in perspective.
So here's the game plan for today. We're going to look at a third way to invest, then pitch shortcuts against the long view. We'll get into the soul of a corporation, and I'll lay out 3 pillars for ethical investing. We'll also cover how ethics can be your secret weapon against competition, and finally, how profits can become a simple natural byproduct of a bigger mission. Let's do it.
Okay, first up, the third way to invest. We're going beyond the typical stats and market psychology here. When most people think about investing, they're usually in one of 2 camps. But what if there's a third way, a path most people don't even consider?
So you've got your 2 main groups, right? First, you have the number crunchers. They live and die by the spreadsheets, all about the stats. Then you have the market psychologists, the ones trying to guess what the crowd is going to do next. But what if there's a third way, an ethical approach? This isn't about numbers or crowd behavior. It asks a much bigger, much simpler question. Is this company actually making the world a better place? And the argument we're looking at is that over the long run, the answer to that question, well, that's what really predicts who wins.
This is such a great way to think about it. In the short term, it really does look like the chiselers and the cynics are winning, right? It feels like the ethical path and the profitable path are miles apart. But look further down the road. It's like a set of railroad tracks. From where you're standing, they look like 2 separate lines.
But if you look way out to the horizon, they meet. They become one. That's the idea here. Over time, ethics and profitability, they converge.
Okay, so let's make this less abstract. It's time for a real-world example, a classic story of two automakers. This really highlights the battle between taking shortcuts and playing the long game.
You just gotta love this quote. Seriously. When better cars are built, we'll copy them. That's a real thing an executive at Chrysler said back in the 30s. Think about that mindset. It's basically saying, we're not gonna lead. We're gonna wait for someone else to do the hard work, and then we'll just copy it. Now compare that to their rival, GM, whose whole thing was, when better cars are built, we'll be the ones building them. You couldn't have two more different ways of looking at the world.
So who won? Well, the proof is in the pudding. Look at this chart. Over the next 3.5 decades, GM stock grew 3 times as much as the copycat companies. Yeah, sure, maybe being a follower saved them a few bucks here and there in the short term, but for anyone who invested for the long haul, the difference was, well, it was absolutely massive.
And hey, this wasn't just a one-off thing with cars. History's littered with these examples. On one side, you have the builders. The principled leaders like J.C. Penney or Henry Ford. They built things to last, creating real, enduring fortunes. And on the other side, you have the manipulators, the financial wizards playing games. They look brilliant for a minute, right? Their careers are meteoric. But just like a meteor, they burn out fast and leave pretty much nothing.
All of this really leads to a deeper point. It's not about a single decision or a single leader. It's about the very soul of a corporation. This section is all about why culture is king, how the very DNA of a company is what ultimately decides where it's headed.
This analogy is just perfect. Think about it. Your body replaces almost all of its cells every 7 to 10 years. So you're literally not the same person physically that you were a decade ago. But you're still you. Your identity, your personality, it's still there. Well, the idea is that corporations work the exact same way. People come and go, employees, managers, even the CEO. But the culture, that stays. Because the culture is what determines who gets hired, who gets promoted, and who fits in. It becomes this powerful, self-perpetuating system.
And the implications of this are huge. If you get a leader with, let's say, questionable morals, they're going to hire more people just like them. It's like a moral cancer that spreads through the organization. And that kind of infection, it can take a generation to purge, long after the original leader is gone. But the opposite is also true. A great leader sets a high bar, and that standard of integrity can outlive them by decades. So for you as an investor, the mission is crystal clear. Find those companies with lasting integrity and run. Don't walk from the ones with that moral cancer.
So check out this story. B. Brewster Jennings, he's the CEO of Mobil Oil. Someone hands him a press release. Now, it's technically true, but it's slippery. It's misleading. And he refuses to sign it. He tells his employee, and remember, this is in private, no cameras around. He says, "I don't ever want to say anything that those who know the most can question." Wow. That's not for a PR stunt. That's who he was. That's what real integrity looks like behind closed doors. That's the stuff that builds a company's soul.
Okay, this is all great, but how do we actually use this information? How do we make it practical? That's what this next section is about. We're going to lay out a strategic framework, the 3 pillars of ethical investing. All right, here they are. Pillar number 1, culture is persistent. Good or bad, a company's character doesn't change on a dime. It sticks around for years. Pillar number 2, deception is inevitable with bad leaders. You can have all the rules and regulations in the world, but if a leader is morally obtuse, they will find a way to hide the truth. And pillar number 3, and this is a big one, don't play the bigger fool game. You know what that is, right? It's when you buy a questionable stock, hoping some other sucker will come along and buy it from you for more. It's a dangerous game, and with an ethical approach, you don't even have to play it.
And really, why would you ever want to play that game? There are more than 50,000 public companies out there. 50,000! With that many choices, why on earth would you waste your time and money on one with a toxic culture or a shady leader? It just doesn't make any sense. There's so many other options. It's not just a bad moral choice, it's a bad strategic one.
Here's a fantastic mental exercise for you. Before you buy any stock, ask yourself this. Would I still buy this if I knew the stock market was going to shut down for the next 10 years? Think about it. If you couldn't sell it tomorrow or next week or next year, would you still want to own it? It instantly changes your mindset from a short-term gambler to a long-term business partner. You're not just renting a stock anymore, you're buying into a company.
Okay, now we get to one of my favorite parts of this whole idea. What if ethics isn't just about feeling good? What if it's one of the most powerful competitive weapons a company can have? This section is all about how integrity acts as the ultimate competition reducer.
You always hear investors talking about a company's moat, right? That special something that protects it from competitors. But what really builds that moat? Is it just a patent, a famous brand? No. The strongest moats are built from things that are almost impossible for a competitor to copy. Things like deep institutional knowledge, a relentless drive for quality, and a reputation for rock-solid integrity. You can't just go out and buy that. You have to earn it, one day at a time, over years. And that becomes a fortress no one can breach.
So this really boils down to one powerful question you have to ask yourself about any company you invest in. Ask this: is this company basically an unregulated monopoly of pure talent and integrity? I mean, are they so uniquely good at what they do and so deeply trustworthy that they're essentially in a league of their own? Because finding a company like that, that's the real prize. That's the holy grail of investing.
And that leads us perfectly into our final section, which really wraps this whole philosophy up. It's a fundamental shift in how we think about profits. We're going to talk about profits as a byproduct, or what you might call the serendipity dividend. Now, this piece of ancient wisdom might seem out of place, but it perfectly captures the paradox we're talking about. The companies that are obsessed with their own survival, the ones that are just trying to save their own skin and maximize every penny of profit, they often end up failing. But the ones who lose their life for a bigger cause, the ones who dedicate themselves to serving a greater need, they're the ones who end up not just surviving, but truly thriving.
So here's the big takeaway. The most incredible investment returns, the ones that truly change lives, they don't come from companies whose only goal is to get rich. They come from companies that are on a mission. Companies that are fired up with a real passion for solving human problems. For these kinds of companies, profit is never the main goal. It's just a wonderful side effect. A happy byproduct that flows from doing something truly meaningful.
So I'll leave you with this final thought to chew on, because this really changes investing from just a financial act to something much more. Every single dollar you invest is a vote. It's a vote for the kind of future you want to see. So the question isn't just, is this a good stock? The real question is, am I investing in the world I actually want to live in? And that, I think, is the most important question of all. Thanks for joining us.
You know, in the world of investing, there's this silent war being waged inside the very companies you and I might own. It's a conflict that every single investor really needs to understand, but honestly, very few ever see it. It's this constant battle between a leader's personal ego and the relentless pursuit of the almighty dollar. For you, the shareholder.
And there's a name for this phenomenon. It's called egonomics. It's a simple, but wow, is it a profound concept? You know, it reminds me of that old story about the schoolboy. His teacher asks him, what's 2 plus 2? And it just fires back, am I buying or selling? See, that's the mind of an economist in a nutshell. Every single decision gets filtered through this lens of personal gain and status, not objective truth or, more importantly for us, profitability.
So here's the crucial question for you, for all of us. Is this hidden force quietly sabotaging your portfolio right now? Is the ego of some CEO out there silently just eating away at your returns? Well, as we're about to see, the answer is often a pretty resounding yes.
So here's our game plan for today. We're going to start with what I call the economics trap. Then we'll dive into the red flags you got to watch for. We'll look at a real-world case study on U.S. Steel, then flip it and outline the anatomy of a winner. And finally, we'll talk about how you can develop your own investor's sixth sense for this stuff.
All right, section 1, the economics trap. So how do you actually spot when pride is being put before profit? Well, here's the key. You have to learn to completely ignore what executives say and focus entirely on what they do. Believe me, their actions speak so loudly that their words just become meaningless noise.
And that brings us right into section 2, the red flags. Now, these are the practical, observable signs that tell you management is serving its own ego, not serving you. Think of this as your investor's toolkit for spotting trouble before it gets out of hand.
First one up, red flag number 1, a relentless, almost obsessive focus on growth over profit. See, the corporate economist just loves making their company bigger, not necessarily more profitable. So when you see a company that's earning a consistently low return on its capital, yet it keeps pouring your money, the stockholders' money, into more expansion to improve its competitive position, that is a massive, massive warning sign. Red flag number 2 is what I like to call the corporate monument. You know what I'm talking about. When a company starts paying way more attention to its lavish, stately headquarters than it does to its sales and profit margins, you can bet that, as our source material says, exonomist termites are at work. And this quote just says it all. When a business gets stately, wise investors get out.
It's so true. These grand buildings are often just mausoleums for past earnings. They're celebrating some past glory instead of actually generating future profits. A business is about progress, right? It can't be anchored to a pile of bricks.
Okay, now for one that's a bit more subtle, but man, it's just as destructive. Red flag number 3, the intellectual bully. A leader's personality can either be the soil that helps innovation grow, or it can be the poison that kills it. Let's look at 2 totally different types of executives.
So on one side, you've got the contributor. You bring this person an idea, they find what's good in it, they actually build on it and make it even better, and then, get this, they give you the credit. Now, on the other side, you have the egomanist. You bring them that exact same idea, and their first instinct is to find what's wrong with it, to belittle it, and in doing so, to belittle you. Their deep-seated need to prove they're the smartest person in the room creates this culture of fear. It absolutely stifles new ideas, and it drives your most talented people right out the door. The hidden cost to the company is just enormous.
And that leads us perfectly into our 4th red flag, the one-man show. This is the leader who hogs the corporate spotlight, who just has to be the face of every single success and the source of every good idea. And what this does is create an organization that is incredibly fragile.
So why is this so dangerous? Well, first off, they hog all the credit, right? So the best and the brightest people, they eventually leave. They know they're never going to get the recognition they deserve. And then, this leader fills those now empty roles with people who are more servile, less likely to challenge them. The organization's creative spark just starts to dim. And worst of all, the entire company is left literally one heartbeat away from deep trouble.
All right, so let's try and put a real price tag on all this theory. Let's move to Section 3, our case study on U.S. Steel. This is where we get to see the devastating financial consequences of corporate ego out in the real world.
Okay, so for a full decade, U.S. Steel was the undisputed leader in its industry, but it was reinvesting its earnings year after year for just dreadfully poor returns. Let's actually look at the numbers and see what that persistently low performance really cost its shareholders.
Just take a moment to really let this sink in. This is a whole decade of performance. We're looking at 2 key numbers here, return on invested capital and return on equity. You can just think of them as a report card for how well a company uses its money to make more money. And as you can see, for 10 straight years, the return on invested capital rarely even broke 6%. Year after year, shareholder money was being funneled into a business that simply wasn't generating adequate returns. The numbers here don't lie. This is a story of massive value destruction.
And here it is. This is the most damning takeaway of all. By 1970, the company could have earned twice as much by simply taking all that money and investing it in boring, safe government bonds. Just let that sink in for a second. Management chose the prestige of expansion over the simple, profitable, and frankly, sensible alternative. That, my friends, is the staggering cost of ego.
All right, that's enough of the doom and gloom. Let's pivot and look at the positive side of the coin. Section 4, the anatomy of a winner. What does the powerful opposite of an economics-driven company actually look like?
Here it is. This is the blueprint for a winning business. Number 1, it's a terror to its competition, not prey for them. 2, it's headed by a fighting leader with courage and real imagination. But, and this is so important, number 3, a hard-nosed realist handles the money. 4, the whole company is filled with a spirited team, young, hungry people who have tasted success and they want more of it. And finally, it often operates in a new field with years and years of opportunity ahead. It's a culture that's built on progress, not on prestige.
And you want the perfect example of an anti-economist? Look no further than John W. Hill, the founder of the big public relations firm Hill and Knowlton. Now, in a business where brains are pretty much the only asset you have, his strategy was incredibly simple. Surround himself with people who were more able than he was. He went out of his way to elevate his associates, giving them titles, key client relationships, and public recognition. Now that is true managerial wisdom, understanding that your success comes directly from the success of your team.
Okay, let's bring this all home in our final section, your investor's sixth sense. This is all about learning to read the human element in a business, because at the end of the day, piles of brick and stone mean absolutely nothing. Real profits are the reward of the human spirit.
There's an old saying I love, a whiff of smoke can be louder than a fire alarm. And it's so true for investing. It's about paying attention to the small things. For an alert investor,
one tiny, seemingly insignificant detail can reveal more about a company's culture than a blaring alarm bell in a financial report.
And here is just a fantastic story from history that illustrates this perfectly. It's called the scissors test, and it comes from Clarence W. Barron, who used to own the Wall Street Journal. Whenever he was interviewing a young job applicant, he'd ask the person to do something simple: clip a story out of the newspaper for him.
Barron's logic here was just brilliant. If the applicant hacked out the clipping clumsily, ruining all the stories around it, it revealed a whole host of character flaws. It showed carelessness, wastefulness, and a real lack of observation. His thinking was, if a person couldn't even be bothered to master a simple task like using scissors properly, how in the world could they ever be trusted with something complex and important?
And that leaves us with this one final crucial question. When you make an investment, are you just analyzing the business, the balance sheets and the income statements, or are you truly analyzing the person running it? Because as we've seen today, that battle between the almighty ego and the almighty dollar, well, that's often the one that determines everything.
Welcome, everyone. All right, I want to kick things off today with a pretty wild idea from the investor Thomas Phelps. What if I told you that inflation, that thing that's always eating away at your savings, what if I told you it's basically a form of cheating? These aren't just some dusty old theories. This is really the foundation for understanding how your money actually works. So let's get right into it.
So there it is, right at the start. Phelps doesn't pull any punches. He says inflation isn't some complex, unavoidable force of nature. Nope. He says it's something that happens when people try to get something for nothing. Now that is a bold statement. And to really get what he means, we have to take a step back and ask a much more fundamental question.
If you're going to invest your money with any kind of sense, you have got to have an answer for this. We're so often told this is some ridiculously complicated subject that only economists can understand. But Phelps says, look, it's not that hard. It really just comes down to three main things.
These are the three pillars. First, you've got money that's valuable all on its own. Second, there's money that's valuable simply because the government says you got to have it to pay them. And third, well, that's money that has value because the government is just plain strong enough to make it so. Let's break each of these down, starting with the one that's been around the longest.
Think way back. Gold, for instance, or even salt. Fun fact, that's where the word salary comes from. To get more of it, you had to physically go out and do the hard work of mining it or gathering it. And that work was pretty much equal to the value of whatever you could trade it for. The beautiful thing about this system is it's got a natural brake on inflation. You can't just magically create more gold. There's no profit in it. But obviously, the $5 bill in your wallet doesn't work that way. So what gives that its value?
Well, this leads us to the second and honestly pretty mind-blowing factor: taxes. Phelps tells this amazing story from history. Back in the Belgian Congo, the government had a serious problem. The local population, they were self-sufficient. They had no need for the Belgian franc. It was just a useless piece of paper to them. So the big question was, how do you make something that's totally worthless suddenly valuable?
And boom, just like that, with one simple move, they changed the entire game. All of a sudden, every single man needed to get his hands on Belgian francs. Not because they wanted to buy anything, but simply to exist, to live, without getting thrown in jail by the authorities. A demand was literally created out of thin air.
And that is just a perfect example of how a government can breathe value into pieces of paper. By forcing you to use that paper to pay your taxes, it creates this baseline of demand that everyone has to participate in. It's an incredibly powerful tool. But then there's the third factor, the one that's the most blunt.
This is Phelps's raw analogy for what he calls fiat value, which basically comes from the Latin word for let it be done. This is money that has value simply because the government says so, and they have the power to back it up. It forces people to accept it, sometimes through things like price and wage controls. It's value that comes directly from power.
Okay, so keeping those three things in mind, inherent value, taxes, and force, we can finally talk about inflation. Phelps has a name for it, the crudest tax. See, when governments spend more than they take in through normal taxes, they have this other lever they can pull. They can just create more money. And that takes us right back to his original idea of cheating.
The way Phelps sees it, the math here is brutally simple. When a government starts funding things with money that just appears out of a printing press, it's not a free lunch for anyone. It is a tax. It's just not one that gets debated and voted on. Instead, it gets collected from every single one of us every time we go to the store and see that prices are higher than they were last year.
And this isn't just about what the government does. Phelps argues the same dynamic plays out in what's called the wage price spiral. He says when really powerful groups can, say, shut down a whole city to force a wage increase, the government gets backed into a corner. If they don't want to see massive unemployment, they often end up validating those new higher wages by creating more money. And that, in turn, just makes everyone else's money worth less.
Now, this wasn't some theoretical idea. This was a real thing, said directly to Phelps by John L. Lewis, who was the incredibly powerful head of the United Mine Workers back in the day. It's just a raw, honest statement about power, the power to bring things to a screeching halt to get what you want.
And that was Phelps's response to him, a question that, apparently, was met with total silence. It's a pretty intense comparison, for sure, but it gets to the heart of his argument about the fine line between negotiation and what can feel like a shakedown, a dynamic that can really pour gasoline on the fire of inflation.
So this constant threat of inflation, this slow dilution of our money, it has a huge knock-on effect. It directly impacts the cost of borrowing and lending. And that brings us to our next big topic for any investor, interest, and the surprisingly tricky role of debt.
So, the age-old question, is debt good or is it bad? I mean, the conventional wisdom that I think a lot of us grew up with is avoid it like the plague. But Phelps shares this personal story, a really painful one financially, that just blows that simple idea right out of the water.
So here's the setup. It's 1954. He gets a doctor's bill. He's a cautious guy, financially prudent, so he thinks, okay, I'm not going to take out a loan for this. Instead, he decides he'll sell an asset to cover it. I mean, that's what most responsible people would do, right?
And that's how much the bill was for. Just over $7,000. Not a fortune, but definitely not pocket change either. So he sells some of his stock in this up-and-coming company, pays the bill, and that's that. No debt, no monthly payments, no worries. Or so he thought.
He asked this question right in the text. And you look at it on the surface, and of course you'd say, yes. He avoided paying interest. He slept well at night knowing he didn't owe anyone a dime. But the real cost, the true cost of that prudent decision, was hiding in plain sight, and it would take years to reveal itself.
See, time is the ultimate judge of any financial move. The tiny bit of interest he would have paid on a loan was one side of the coin. But the other side, the opportunity cost, what he gave up by selling, was about to become shockingly, terrifyingly clear.
Yeah, you heard that right. Almost $1 million. The asset he sold to avoid a small debt didn't just grow a little bit. It went ballistic. It absolutely dwarfed the cost of the loan he so carefully avoided. And this brings him to his huge realization.
That one sentence just changes how you think about debt entirely. It's not this evil thing to be avoided at all costs. It's a tool. And the smart question isn't, should I avoid debt? The real question is, can I earn more with this borrowed money than it's going to cost me in interest? In his case, the answer was a massive, painful yes.
All right, so all of this, money, inflation, debt, it all leads us to the final practical decision that every single one of us has to make with our capital. At the end of the day, it's a choice between two roles. You can either be an owner or you can be a lender.
Let's just lay it out, nice and simple. When you buy a stock, you become a part owner of a business. You get the share in the profits, you get the upside if the company grows, but you're promised absolutely nothing. If it goes to zero, you get zero. Now, when you buy a bond, you're a creditor, you're a lender. You are promised that you'll get your money back with interest. But that's it. You are completely blocked from any of the company's success beyond that fixed payment. Your upside is totally capped.
So we're left with the ultimate investor's dilemma. In a world where we know the value of our dollars is constantly slowly leaking away, does it make more sense to be an owner with all the risk and all the potential reward? Or is it better to be a creditor with a promise of safety that might just be an illusion as inflation eats away at your returns? Now, Phelps doesn't give you a simple answer because there isn't one. His whole point is that you, the investor, have to figure out the odds and decide which side of that bet you want to be on. And in a world with inflation, that's a choice you are making every single day, whether you realize it or not.
All right, let's jump right in. We have all heard that classic piece of investing advice, right? Buy right and hold on. It sounds so simple, almost too easy. But the truth is, hiding inside that little phrase is one of the toughest challenges any of us will ever face as an investor. Today, we're going to unpack exactly why that is.
And this quote, well, it just nails it, doesn't it? It perfectly captures that giant canyon between knowing the strategy and actually being able to execute it. It's the difference between having an idea and, actually making a fortune from it.
So this simple advice, buy right and hold on, we can call it the master plan. It's catchy, it's memorable, and it's dangerously incomplete. It's like someone hands you a treasure map, points to a big X that says wealth, but forgets to include any of the landmarks, the terrain, or the directions on how to get there. To really get our heads around this problem, the source material we're digging into today gives us this brilliant, kind of updated Aesop's fable. It's about a grasshopper and an ant, sure, but it's really about the massive flaw in getting advice that sounds amazing, but gives you zero practical steps to follow.
So picture this, right? Summer's over. The grasshopper, who's been living it up all season, suddenly gets that cold feeling that winter is coming. He looks over and sees the ant, who's been working like crazy, all set up in a cozy, well-stocked home. So in a total panic, the grasshopper runs over and asks, "What should I do?"
The ant, without even skipping a beat, offers a solution that sounds, well, it sounds perfect. Easy, he says. Change yourself into a cockroach. Then you can just crawl into any house you want and stay warm and find food all winter long. I mean, it's a brilliant idea, right? Problem solved. But, of course, there's a tiny little problem. The grasshopper thinks about it for a second and then asks the single most important question you could possibly ask in this situation. How do I do that? How do I actually pull off this amazing plan you just gave me? And here it is. This is the punchline that brings it all back to investing. The ant just shrugs and says, "Look, I've given you the master plan. It's up to you to work out the details." And just like that, the grasshopper has a fantastic goal but no method, and is going to be left out in the cold. That is the exact danger of just hearing buy right and hold on and not knowing the how. Okay, so this is where we are going to work out those details. The source material breaks this massive challenge down into two very distinct, very big hurdles that every single long-term investor has to figure out how to clear.
And here they are. First, you've got to somehow pick the right thing to invest in right out of the gate. That's buying right. But then, and this is just as hard, even if you get that first part correct, you have to have the deep conviction and the knowledge to actually stick with it through all the ups and downs. That's knowing enough to hold on. It's really like you're fighting a two-front war against total uncertainty.
And this right here, this is that second hurdle in a nutshell. Holding on isn't a passive activity where you just sit back. No, it's an active defense. You are going to be constantly bombarded by noise, from experts, from analysts, from scary headlines, all of them telling you why you need to sell. And the really tricky part is, sometimes they're right in the short term, which makes it even harder to trust yourself and stick to your guns the next time around.
So let's circle back to that first hurdle for a second. Buying. Right, because if holding on is a psychological battle, picking the right investment to begin with is a staggering mathematical challenge. It is so easy to underestimate just how slim the odds are.
The odds are just not on your side if you're relying on pure dumb luck. Just think about this. Your mathematical chance of randomly picking one of those legendary 100-to-1 stocks, just by sticking pins in a stock page, is literally 1 in 100. Relying on luck is pretty much a blueprint for failure.
So the critical takeaway here is that you can't just guess your way to success. To beat those long odds, you have to move from luck to making an intelligent choice. And that means you have to develop a specific skill. The skill of perceiving the tendency of events, seeing where the world is actually going before everyone else gets there.
And perceiving the tendency of events, well, it sounds nice and simple, but this is what it really looks like. It's not about one thing. It's about seeing how all of these huge forces are connected. You can't just look at interest rates, for example. You have to ask, okay, if rates go up to fight inflation, how does that change the whole game? Does that make safer things like bonds look way better than stocks? And then on top of all that, how does the political climate, a new law, a trade war, how does that affect everything else? It's this massive interconnected puzzle, and the real work is trying to see the whole picture.
So, how on earth is anyone supposed to do this? Well, you don't need a crystal ball. What you need, according to our source, is a very specific kind of mindset, a way of thinking that lets you bridge that gap between the world you see today and the future that's just around the corner.
And here it is. This is the core concept, practical imagination. I just love this definition. It's not about daydreaming. It's the disciplined skill of seeing a future that doesn't exist yet, but is close enough that it's going to matter to the decisions you make today. It's about connecting dots that most people don't even see are there yet.
This analogy from the source just puts it perfectly. Having practical imagination means you actually understand the rules of the game you're playing. You're not going to bet on a champion racehorse to win a milk-producing contest. You know what factors actually lead to success in your field, and you know how to spot them early. So we're going to end on this question, because the real master plan isn't just buy right and hold on. It's about cultivating your own practical imagination.
It's about looking at the world around you, at all that complexity, and asking yourself this one powerful question. What future is not here yet, but you can see? Because the answer to that might just be the one detail that makes all the difference.
All right, today we're tackling one of the biggest questions in investing, maybe the holy grail. How do you actually find stocks that can go up 100 to 1? You know, the kind of return that is genuinely life-changing. Now, for most people, it feels like winning the lottery, pure luck. But we're going to dig into a framework today that suggests it might be more of a science than you think. You know, to get us started, I want to share this quote that just flips everything we think we know upside down. It's from Bernard Baruch, an absolute legend, one of the most successful investors ever. And he was talking about big, safe blue-chip stocks. And he said he couldn't afford them. I mean, think about that. For a guy with his kind of money to say that, it really makes you pause. So a comment like Baruch, it just feeds into this idea we hear all the time, right? That if you want to hit it big, you got to fish in the bargain bin with penny stocks. The logic seems simple. It's a lot easier for a 10-cent stock to go to $10 than it is for a $100 stock to go to $10,000. It feels right, it feels intuitive, but is it actually true? Well, the material we're diving into today basically says that this whole way of thinking, this map that points everyone towards the cheapest, sketchiest stocks, what if that map is just wrong? What if it's actually leading us in the completely opposite direction of where the real treasure is buried? Okay, so let's just rip up that old map right now. When you actually look at the data, the historical record, it's fascinating. Somebody studied over 365 stocks that pulled off this incredible 100 to 1 return. And the results? They were just stunning. Most of these massive winners weren't penny stocks on some weird, obscure exchange. Nope. They were hiding in plain sight, right on the New York Stock Exchange. The whole idea that you have to go into the shadows to find these huge gains, it just completely falls apart. So, if the old map is garbage, where's the new one? Well, the source material tells us that the real treasure isn't found by staring at stock prices. It's found by looking up from the screen, looking at the world around you, and spotting the huge, game-changing trends that are reshaping everything. And the key word here is revolutionary change. We're not talking about a slightly better mousetrap. We're talking about things that create whole new ways of living. I mean, think about the jump from a horse to a car, or from a handwritten letter to an email. These are the giant shifts that create absolutely enormous new markets out of thin air. And these hunting grounds also pop up when companies are trying to solve humanity's biggest, most stubborn problems. This isn't about finding the next hot gadget. This is about finding companies that are tackling huge challenges, sustainability, managing our resources, logistics, you know, the kinds of problems that, if you solve them, you create massive, lasting value for everybody. Okay, so we have a better idea of where to look, these big areas of innovation. But history also gives us clues about what these winning companies actually look like. The author went back and studied the big winners and found that they tend to follow one of 4 distinct patterns, 4 different paths to get to that incredible return. And this slide lays out those 4 paths perfectly. The first one is the recovery play. That's when you buy a fantastic company when it's just getting hammered during a market panic. The second is the commodity boom. Basically, you correctly bet that the price of something like oil or copper is about to go to the moon. The third is leverage, a really high-risk, high-reward strategy using debt to juice your returns. And the last one, the fourth path, is the slow, powerful magic of compounding. Just finding a great business that can keep reinvesting its own money at high rates of return for a really, really long time. But let's be crystal clear here. This is not some simple treasure map where X marks the spot. It's full of traps and dead ends and dragons. Understanding the risks is every bit as important as seeing the potential rewards. Maybe even more so. So let's start with one of the most powerful and, frankly, one of the most dangerous tools in the box, leverage. This is that third path we just mentioned. Simply put, it's using borrowed money to make your bet bigger. You're basically controlling way more assets than you actually paid for. And here's a perfect example of how wild this can get. So imagine this special fund. It's got income shares, they get a small fixed return, and capital shares, they get all the growth. You buy the capital shares for $5. Now, look at the table. If the whole pot of assets grows 5 times, from $16 to $80, the income shares still only get their $10 back. That means the other $70 of value, it all goes to you. Your $5 investment is now worth $70. That's a 14 times return on a 5 times gain. That is the explosive, insane power of leverage. However, And this is the warning that should be flashing in red lights. Leverage is a brutal, double-edged sword. Let's use that same example. What if the assets had dropped from $16 down to just $8? Well, the income shares are still owed their $10, which means your shares, they're not just worthless, they're negative. You get completely wiped out. Leverage magnifies your losses just as violently as it magnifies your gains. And that's why, for that fourth path, the long-term compounding path, a company needs more than just a good idea. It needs a protective moat. The author calls it a high gate. It's something that keeps the competition out, so they can't just come in and steal all the profits. We're talking about things like a huge portfolio of patents, a brand that people absolutely love, or some kind of tech that is just impossible for anyone else to copy. Okay, so finally, let's really look at the engine behind that fourth path, the one that's the most reliable of all. It's not flashy, it's not quick, but it is absolutely relentless. And that's the simple, beautiful power of compounding growth over time. So what does it actually take mathematically to turn $1 into 100? Well, this timeline lays out the pretty demanding numbers. If you've got 40 years, you need to grow at about 12% a year. But look what happens when you shrink the time frame. To do it in just 20 years, you have to grow at 26%. Every single year, no exceptions. That is an incredibly high bar to clear for that long. Now, it's really easy to get mesmerized by those numbers and think, okay, I'll just find a great company and it'll grow at 25% forever. But, the laws of math and economics, they eventually have their say. So let's just run a quick thought experiment to see why that's not possible. I love this illustration from the source material. If you had invested a single dollar, earning a pretty modest 5% a year since the year one, today it would be worth a number so big you'd need a solid ball of gold almost 90 million miles wide just to pay it off. The point is just crystal clear. At some point, every single exponential growth curve has to flatten out. It's just a mathematical impossibility for it to go on forever. And here's why that matters in the real world with real companies. For a company that's already a giant, like General Motors was back in the day, growing another 100 times over just isn't going to happen. Its sales would have to be bigger than the entire US economy. So part of the hunt is realizing you have to find these amazing companies while they're still small enough to actually have room to grow that much. So, what does this all boil down to? When you put it all together, it's not really about some magic formula or a special stock screener. It's about developing the right mindset. It's having the patience to let your winners run for decades, not months. It's having the vision to see those new hunting grounds. It's having the humility to know you're going to be wrong sometimes. And it's having the discipline to stick with it through all the ups and downs. And that leaves us with the final and really the most important question of all. The principles we talked about today, they're timeless, but the opportunities themselves, they're always changing. The original author was looking at a world that was being totally transformed by cars and the first computers. So as we look around our world today, where are those new hunting grounds? Where are the next revolutionary trends? That's where the hunt begins again. You ever look at the news, the chaos, the economic worries right here at home, and just think to yourself, I've got to get my money out of here? It's a really powerful feeling, isn't it? This idea that the real opportunities have to be somewhere else, far away from all this noise. So let's dive into that very human, very real instinct for an investor. The author of our source material just nails it with this image. He talks about cattle in a field. They're always looking at the grass just on the other side of the fence, convinced it's gotta be greener, more delicious. And here's the kicker. We investors do the exact same thing. We look at some distant, unfamiliar market and we think, now that's where the growth is. That's where I can get away from all the problems I know so well right here. And that's really the billion-dollar question, isn't it? Is the grass actually greener over there? Or are we just trading a set of problems we can see and understand for a whole new set of hazards that are totally invisible from a distance? In other words, does running away from trouble at home actually pay off? Well, history gives us some pretty powerful clues. The author brings up the 1930s in the US, a time of incredible upheaval with the New Deal, the dollar getting devalued, you name it. A lot of so-called sophisticated investors got scared. They fled. They sent their money to what they thought were safe havens like Argentina and France. But what did they miss? They likely missed one of the greatest buying opportunities in the history of the American stock market. They passed on amazing bargains right under their own noses, all for risks they couldn't possibly have seen coming. So how do we get this right? Here's what we're going to do. First, we'll really dig into that grass is greener feeling. Then we'll lay out some hard and fast rules for looking overseas. From there, we'll jump into a fantastic case study all the way down under. Then we're going to flip the script and look at a huge crisis brewing back home, which will lead us to the biggest insight of all, how to find incredible opportunity that's disguised as peril. Okay, so if we are going to look for opportunities abroad, how do we do it without falling into all those classic traps? The author isn't saying you should never invest overseas. Not at all. Instead, he lays out a really disciplined way to think about it, a framework that was born from some hard-won experience. And this is a perfect example of what I mean by hard-won experience. This is a wild story. During World War II, the author had British clients who owned U.S. stocks. Smart, right? Well, in 1942, right near the bottom of the market, the British government just took those securities from its own people. They called it sequestering, which is a fancy word for confiscating them, and they sold them off to get U.S. dollars to pay for the war. I mean, think about that. That's a political risk you just cannot see coming from thousands of miles away. So all this leads to the author's 2 essential rules. Rule number 1, if you're investing somewhere else just to escape trouble at home, you better be ready to pack your bags and go with your money, because if things get really bad, you've got to be there on the ground. And rule number 2, if you're staying put, that opportunity overseas needs to be staggeringly better. Not just a little bit better. It needs to be better by a wide, wide margin. That margin is what pays you for everything you don't know: the local customs, the politics, the hidden risks. And here's the big mindset shift. Stop thinking about it as escaping. Instead, think of yourself as a disciplined worldwide hunter for the absolute best values you can find anywhere on the planet. When you do that, something amazing happens. The protection you get from problems at home, that just becomes a free bonus. It's a byproduct of just being a smart global value investor. You get the insurance for free. All right, so what does an opportunity that actually meets this really high standard look like in the real world? Well, the author points us to the other side of the globe, to a place he says is a perfect example of the old saying that nature abhors a vacuum: Australia. I mean, just check this out. This one chart says so much about Australia's built-in strength. After the massive crash of 1929, it took the US, the UK, and Canada a full 25 years to get their stock markets back to where they were before the crash. 25 years. You know how long it took Australia? 5. Just 5 years to hit new highs. That is a huge sign of an incredibly dynamic and resilient economy. Now, to really wrap your head around the opportunity the author saw, let's start with something familiar: the United States. To find all of its oil and gas, we have drilled over 2 million wells. 2 million. That is a mind-boggling amount of exploration. Just keep that number in your head for a second. 2 million. Now, let's look at Australia. At the time our author was writing, you know how many oil wells had been drilled there? 2,000. That's it, not 2 million. 2,000. The difference is just, it's almost hard to believe. But it gets even crazier when you add the last piece of the puzzle. And here's the kicker. Australia is almost the exact same size as the continental United States. So you've got 2 giant continent-sized countries, but one has been picked over for resources 1,000 times more than the other. That is the very definition of a vacuum, of just massive untapped potential just sitting there. So the whole argument for Australia really boiled down to these 4 things. It's big, we just saw that. It's empty, a tiny population on a huge landmass. It's unexploited, as that oil well number proves. And here's the crucial part: it was technologically advanced. It could use modern tools to basically leapfrog decades of slow, painful development. And this quote just perfectly captures what unexploited means. The potential was so obvious that people were literally tripping over world-class discoveries by accident. There's a story of bauxite being found because a plane's engine conked out over an old airstrip. A pilot flying low to get under a storm spots a mountain made of high-grade iron ore. I mean, the resources were practically jumping out of the ground, just waiting to be noticed. And the key that unlocked all this potential? It was technology. For a long time, the continent was just too big and too harsh to tackle. But then came waves of new tech. First, you had giant earth-moving equipment. Think huge caterpillars and shovels that suddenly made massive mining projects profitable. Then things really took off. Airplanes connected remote spots that were impossible to get to. New tech could find water deep underground. And of course, air conditioning made the vast tropical north actually livable. The whole continent was coming online, one powerful piece at a time. All right, hold that thought about Australia for a second. Let's snap back home. Because while all of this incredible opportunity was bubbling up down under, what was happening back in the States? The very kind of peril, the very crisis that makes investors want to run for the hills was boiling over, especially in America's biggest cities. Our source material lays out some pretty stark data from the 1960s in New York City. The city lost more than 600,000 white residents. At the same time, it gained over 700,000 non-white residents. This was a time of massive social and demographic change, and it put an incredible amount of stress on the city. And you could see that stress in the city's budget. In just 10 years, the number of people on relief, what we'd probably call welfare today, just skyrocketed. It went up by almost 900,000 people. By 1971, more than 1.2 million people in New York City were receiving relief. This was a full-blown financial crisis. It was the absolute picture of urban decay. Now, looking at all this, the author comes to a pretty provocative conclusion. He says this isn't some natural decline. He sees these forces, the social shifts, the financial pressures, as something active. He claims the cities were effectively being murdered. This is exactly the kind of doom and gloom that makes people want to sell everything and send their money to, well, a place like Australia. But this is where the whole lesson comes together. This is the big revelation. See, most people would look at the opportunity in Australia and the crisis in New York and see two totally separate stories. They'd see a clear signal: flee the crisis, chase the opportunity. But the truly great investor sees that they're just two sides of the same coin. So instead of running away, the author looked at the absolute mess in the big cities and saw something completely different. He saw a problem so huge, so fundamental to the country's future, that it had to be solved. And he knew that solving it would create gigantic investment opportunities. The desperate need for better mass transit, new housing, improved education, modern healthcare. That wasn't a sign of death. It was the seed of the next boom. And that's really the idea that ties this whole thing together. That moment of maximum pessimism, whether it's a stock market crash or a city in crisis, is almost always the point of maximum opportunity. What looks like the end of the world is so often just the darkness right before a new day begins. So all this leaves us with a challenge for right here, right now. The examples of Australia and New York City are from the past, but the principle, that's timeless. This is a way of seeing the world. So the question for all of us today is this: what looks like an unsolvable crisis right now? What is the big, scary peril that everyone is trying to run away from? Because if you look at it just right, that might be exactly where the next great opportunity is hiding in plain sight. All right, let's talk about something that's probably on a lot of our minds. After seeing some of the most incredible market growth in history, there's this nagging question that just won't go away. And it's a really heavy one, isn't it? It's this deep-seated fear that, maybe the golden age is over, that all the easy money has been made. It kind of feels like we've shown up to the party right when they're turning on the lights and sweeping the floors. But is that feeling, is it actually real, or is it just a feeling? Well, that's exactly what we're going to dig into today. So, here's how we're going to tackle this. First, we'll look at a really unique time in the past that kind of set the stage for everything. Then we'll face that big question head on. After that, we're going to look forward to see what might be just around the corner. We'll even look for opportunities in some pretty unexpected places. And we'll wrap up by talking about the kind of mindset you need to actually bet on what's next. To really get a handle on where we might be headed, we have to be super honest about where we've been. And that period, from the depths of the Great Depression all the way to the mid-1960s, man, that was a truly one-of-a-kind moment in history, like nothing else like it. I mean, just look at these numbers. Seriously. On July 8th, 1932, we're talking the absolute rock bottom of the crash. The Dow hit a low of just over 40. Fast forward to February 9th, 1966, and it broke 1,000 for the first time. From 40 to 1,000, that is just, it's a mind-boggling, life-changing run. So the big question is, what on earth was the rocket fuel behind that? Well, believe it or not, the biggest driver wasn't just companies making more money. It was a massive, seismic shift in how people felt. In psychology, take a look at this. Back in 32, in the middle of the Depression, everyone was so pessimistic that companies were trading for half of what their physical stuff was worth. Stocks had to pay out twice what a safe bond would just to get anyone to even look at them. Now, jump to the 60s. The whole thing completely flipped. Optimism was through the roof. Companies were now valued at twice their book value, and investors were totally cool with stock yields being half of what bonds paid. Why? Because they truly believed in the future. And that huge psychological swing, that was just one piece of the puzzle. It was one of 4 massive, what you call one-time only tailwinds that just propelled everything forward. And this is the key thing to get. These were unique historical moments. We already got the benefit from them. You can't run that play again. Okay, so let's run through them real quick. First, that psychological flip we just talked about, going from total fear to total greed, that alone gave the market a 4-fold boost. 4-fold! Second, after World War II, America's factories were humming, while Europe and Japan's were, well, they were in ruins. The US basically became the factory for the entire world. Third, the US was sitting on a mountain of gold, over $26 billion worth, which let it spend like crazy for years. And finally, we sent out over $140 billion in aid, which helped create brand new markets for all our stuff. Every single one of these was a unique, can't-happen-again event. And this quote really just sums it all up perfectly. We can't get those boosts again for the same reason you can't eat your cake and still have it sitting on your plate. We've had them. The cake is gone. And that right there brings us back to that nagging fear we started with. So that's where we're at. The past was this incredible rocket ride, but the fuel it used is, well, it's gone. It's a pretty sobering thought, right? And it really forces us to confront a very direct, maybe even uncomfortable question. I mean, if we can't rely on those same old tricks, a big psychological shift, being the only industrial game in town, or having a mountain of gold, if those engines are gone, what could possibly be left? Seriously, what's left? Are we just stuck? Okay, but this is where things get really interesting. This is the big pivot. Because the answer isn't about trying to recreate the past. It's about looking for something completely new on the horizon. And to do that, we have to pull the camera back, way, way back, and think about human history in a totally different way. There was this brilliant atomic scientist, Homi Bhabha, who came up with this incredible way of looking at things. He said, look, history isn't just a bunch of kings and battles. He argued you can actually divide all of human history into 3 massive eras, or epochs. And what defines each one? The main source of energy that people use. And just think about the scale of this for a second. The first epoch, muscle power from people and animals, that lasted for tens of thousands of years. Then, just a blink of an eye ago, maybe 300 years, we hit the second epoch, chemical energy. Burning stuff, right? Wood, coal, oil, the entire industrial revolution, cars, planes, everything we think of as modern. That all happened in that tiny little sliver of time. And here's the punchline. Bhabha argued that right now we are standing at the very dawn of the third epoch, the atomic age. And the potential here, it's almost hard to wrap your head around. The scientists back then saw 3 incredible paths opening up. Number 1, limitless power. Clean, endless energy from mastering nuclear fusion, literally bottling a star. Number 2, brand new materials. Using radiation to rearrange atoms and create stuff that's stronger than steel, but light as air. And number 3, and this is wild, creating new life forms. Using radiation to speed up evolution in plants and animals, to maybe, just maybe, end world hunger. We're not just talking about a new engine for the economy here, we're talking about a whole new world. All right, so that's the big futuristic vision. It's awesome, but how does that actually turn into something we can invest in, right? Well, there's that great saying that the best opportunities almost always show up wearing work clothes. They look like problems that need solving. And this quote from Henry J. Kaiser just nails it. Problems are opportunities in work clothes. I mean, that just flips the whole script, doesn't it? It means that every huge problem we're staring at today, it isn't a dead end. It's actually a massive business opportunity just waiting for someone to figure it out. Take pollution. It's a massive problem, which means solving it is a massive opportunity. And that's just one example. I mean, look at this list of frontiers people were dreaming up back then, and so many of them are starting to happen now. Think about it. Cleaning up pollution and creating items that don't just get thrown away. Using lasers to build military defenses that are literally impenetrable. Holograms for real-time 3D communication. Think Star Wars, but for your Zoom calls. Or what about super-cooled cables that could create a national power grid with zero waste? Computers that can understand any language instantly? Or even high-quality, pre-made meals that could free up billions of hours of our time. The potential isn't gone. It's everywhere you look. So the opportunities are clearly out there, but just seeing them isn't enough. Acting on them, well, that takes a certain kind of guts. It takes a complete shift in how you think. moving away from that fear of missing the boat and towards making a real bet on human creativity and our ability to solve problems. And we really shouldn't forget what being skeptical and cynical has cost people over the past 40 years. It's so easy to be the person who says, "That'll never work. It feels safe." But that safety has a huge price tag. And the price is missing out on the future. Just think about all the amazing progress, all the incredible growth that the cynics just wrote off as impossible. This next line it nails the logic behind being optimistic. Bet just this once against the end of the world. If you lose, there will be no one around to collect. It's the ultimate asymmetric bet, right? If you bet on human progress and you're right, the upside is huge. But if you bet on progress and you're wrong because the world actually ends, well, nobody's going to be around to cash in their chips anyway. It's the core of what's known as the Rothschild strategy, buy when there's blood in the streets. Now, that sounds pretty grim, but it's not about being morbid. It's about being incredibly rational. The thinking goes like this. When things are at their absolute worst, when there's total crisis, there are only two ways it can go. Either things get better, or everything collapses. And if everything collapses, your money is worthless anyway. So the only logical bet, the only one that makes sense, is to bet on things getting better. So let's go back to that first question. Have we missed the boat? And the answer is no. But we have to be clear. The specific boat that sailed from 1932, the one with those 4 unique rocket boosters, yeah, that one's gone. But there's a whole new fleet being built right now, powered by the completely new engines of this third epoch we talked about. The past was about rebuilding. The future, it's going to be about inventing. The canvas is still blank. The biggest opportunities are still hiding in plain sight, disguised as our biggest problems. So the only real question left to ask is, where are you going to place your bet?
All right, let's kick things off with a classic story. So, you've got this hungry wolf who comes across a lamb drinking from a stream. The wolf, really just looking for any excuse to pounce, snarls, "You are muddying my drinking water." Now the lamb, being pretty logical, points out, that's impossible. I am downstream from you. The wolf, not missing a beat, tries another angle. Fine, well, you were muddying it yesterday. The lamb explains it was literally just born that morning. The wolf, completely unfazed, just says, then it was your mother. And, well, you know how Aesop's fables go, the wolf eats the lamb. The point is, the excuse didn't matter one bit. The wolf was going to do what the wolf was going to do. The reasons were just alibis.
So let me ask you something. Do you ever feel like that lamb, like there's some big bad wolf out there? Call it fate, call it the market, maybe just the feeling you were born too late, that's already decided how things are going to go for you? It's a really common feeling, especially when we look back at these huge investment wins and just think, man, I missed it. The party's over.
Well, that's exactly the idea we're here to tear down today. We're going to get into the nitty-gritty, the anatomy of a 100-to-1 stock, pulling from some really brilliant analysis of past market giants. The whole point here is to show you that finding these incredible opportunities isn't about when you were born. It's about how you think.
So here's how we're going to break it all down. First, we'll talk about why we need to stop blaming the wolf. Then, we'll introduce you to the incredible 100-to-1 club. We'll dig into the awesome power of starting cheap, unveil the 2-engine rocket behind these massive gains, and then shift gears to investing in the future so you can see how to act on this stuff.
All right, let's jump right in. Section 1. Don't blame the wolf. This is all about ditching those alibis, especially that big one that whispers in your ear, "You're too late. All the great opportunities are gone."
The original analysis puts it beautifully. In life, and definitely in investing, fate is that wolf. It's always cooking up some reason why you're going to fail, why you can't succeed. To get the better of it, you have to stop making excuses and start taking action. So, let's look at the principles behind some of the most successful actions in investment history.
And that's the perfect lead into our next section, the 100-to-1 club. We're going to zero in on a very specific period, from 1961 to 1971, where a whole bunch of companies delivered returns that are just staggering. I mean, we're talking about turning every single dollar invested into 100.
Just take a look at this. This isn't a fluke. This isn't some list of miracles. An opportunity to turn 10 grand into $1 million popped up almost every single year of that decade. Masco in 61, Skyline in 63, ADP in 65. It's not like lightning striking once. This was a whole weather system of opportunity, just waiting for someone who knew how to read the clouds.
Okay, now here's where it gets really interesting. There's a pattern hidden in plain sight here. You'd think these companies would be, I don't know, in all sorts of different exotic fields. But they weren't. Five out of the 7 were in the building industry. Skyline, Fleetwood, U.S. Home, that's no coincidence. That is a huge clue. And we're going to circle back to that for sure.
So what did all these companies have in common? Let's get into Section 3. It all starts with one crucial ingredient, the power of starting cheap. And the way we measure that is with the P/E ratio.
Now, for anyone who's not deep in the weeds on this stuff, the P/E ratio is super simple. Think of it like this. It's the price tag for $1 of a company's profit. If the stock's at $10 and the company earns $1, the P/E is 10. The key thing to remember is that historically the average is around 15 or 20, so a really low number often means a really cheap stock.
And boom, this chart just lays it all out. Look at these numbers. U.S. Home and Development Corp had a P/E of around 3. That's practically giving it away. Even the most expensive one on this list, ADP, was still below the market average. The takeaway is just, it's undeniable. Every single one of these rockets started on a cheap launch pad.
I mean, the original research couldn't be clearer on this. Not a single one of these life-changing stocks was popular. They weren't the darlings of Wall Street. They weren't the stocks everyone was talking about at cocktail parties. No, they were the forgotten ones, the underdogs. And that's exactly why they were cheap.
Okay, so starting cheap is the launch pad. But what's the fuel? How do you actually get from a cheap stock to a 100-bagger? Well, that brings us to Section 4, what I absolutely love to call the two-engine rocket.
It all boils down to this really powerful idea. A stock's price explodes for 2 reasons. Engine number 1 is just the company doing well, right? They're making more money, that's your earnings growth. But engine number 2, oh, that's the magic. That's when everyone else realizes the company is doing well. The whole perception shifts from meh to I gotta have it. And that's your PE growth. And when both of those engines fire up at the same time, it's not 1 + 1, it's 10 × 10. It's an explosion.
Let's use Masco to see how this works in the real world. So, step 1, it was dirt cheap, with a PE as low as 2.7. Then, step 2, the business took off, earnings soared. But here's the kicker. Step 3, the market woke up. Investors went from paying less than $3 for a dollar of earnings to paying over $38. Think about that. Just that change in perception alone would have made you 14 times your money. Now, add in the actual business growth on top of that, and there's your 100-bagger. That's the rocket in action.
All right, so we get the math, that's the how. But the real question is, how could you have possibly seen this coming? Well, that takes a different kind of thinking. And that's what Section 5 is all about, moving from spreadsheets to big ideas. It's about being a visionary, not just a historian. So you've basically got 2 ways of looking at the world here. The statistical investor, they wait for all the proof. They need the numbers to confirm the trend is real. It feels safer, maybe, but you're late to the party. The conceptual investor, on the other hand, is looking at a huge problem and asking, what's the solution going to be? They get in before the proof is obvious to everyone. Yeah, it's a bigger bet, but that's where the life-changing returns are hiding. So what was that big problem back in the 60s? It was housing. Simple as that. You had construction wages going through the roof, you had these ancient, inefficient building codes, and suddenly, the dream of owning a home was just slipping away for millions of families. It was a genuine crisis. And remember that clue we talked about? The 5 out of 7 companies? This is why. It all clicks into place now. These weren't just building companies, they were solution companies. They were tackling the housing crisis head-on with a revolutionary new idea: factory-built, mobile, and sectional homes. They were the answer everyone was looking for.
And right there, that is the whole ballgame for this way of thinking. You have to be willing to invest in the idea before it's a proven fact. Because by the time the news is running front-page stories saying factory-built housing is the future, it's too late. The stock isn't cheap anymore. That second engine on the rocket has already left the station, and you missed the ride. Okay, so that brings us to our final section. We've looked back, we've dug into the mechanics, now it's time to look forward. It's time to talk about how you can turn all this incredible knowledge into a plan for action. So, let's boil it all down into a simple game plan. Number 1, it has to be cheap. A low PE ratio is your ticket to the dance. Non-negotiable. Number 2, find that 2-engine rocket fuel. You need the potential for both the business to grow and for people's perception of it to get way better.
Number 3, think like a futurist, not a reporter. Find the big problem, then find who's solving it. And finally, number 4, and man, this is a tough one. You have to have the guts to hold on. The ride to 100 to 1 is never, ever a straight line.
So we end up right back where we started. Not with the wolf in an excuse, but with a path to action. The point of all this isn't to make you wish for a time machine to go back to the 60s. It's to give you a map for today. So the question I want to leave you with is this. What's the great unsolved human problem of our time? And who is building the solution? Find that, and you might just find the next member of the 100 to 1 club.
You know, we've all heard those incredible stories, right? The ones about people making absolute fortunes in the stock market. But why does that kind of massive success always feel like it's a million miles away from most of us? Well, today, we're going to break down the common traps that keep everyday investors from really winning big. And more importantly, we're going to explore a powerful, maybe even a little unconventional path to building real long-term wealth. I mean, this is the central question, isn't it? Every single year, these fantastic opportunities seem to be just dangling right in front of us. But for most people, they stay just out of reach. We see the headlines, sure, but we never seem to experience those results ourselves. The answer, as one brilliant investor once put it, is both incredibly simple and really profound. It all comes down to what we've been trained to look for. And this quote just perfectly captures the entire problem. I want you to picture this. You're in a field, and it's just full of these giant ripe melons. These melons, they represent the life-changing 100 to 1 investment opportunities. But instead of just picking one up, most of us were on our hands and knees, frantically digging in the dirt, searching for a couple of tiny peanuts. Those are the small, quick trading profits. We get so busy chasing the small score that we completely miss the feast that's sitting right there in front of us. So let's talk about this obsessive search for what we'll call financial peanuts. Look, it's not an accident that we act this way, not at all. In fact, there's a whole system out there that encourages this kind of short-sighted thinking, and it has this powerful, almost hypnotic effect on all of our financial decisions. Now, brainwashed is a really strong word, I know, but you know what? It fits. From the moment we start investing, we are just bombarded with information that has almost nothing to do with finding those truly great long-term companies. We're taught to focus on the daily news cycle, the quarterly reports, the squiggly lines on a price chart, not the fundamental business itself.
And this leads us straight into what's been called the overtrading machine. It's this complex system of incentives and pressures, all designed to do one thing, and one thing only: keep us busy, keep us trading, and keep us jumping from one stock to the next.
And what's so fascinating is how all these pieces fit together to create this machine. I mean, think about it. Brokers, obviously, they live on commissions. The more you trade, the more money they make. Simple. The financial media, they love a dramatic story that moves the market, which makes you feel like if you just react fast enough to the news, you'll get rich. Then you've got tax rules that often push you to sell your winners at the end of the year. And then there's the big one, this absolute obsession with measuring performance every 3 months, which forces even the pros to dump a fantastic company just because it had a couple of rough quarters. I absolutely love this quote. It's some old-school carpenter's wisdom that applies perfectly here. All that activity, the buying, the selling, the constant tinkering with your portfolio, it creates a lot of shavings, a lot of dust on the floor. It makes you feel like you're doing something really productive. But at the end of the day, you haven't actually built anything substantial. You've just been busy. So here's the crucial point. It's all about a fundamental difference in your intent. A trader's goal is to be right over and over and over again on these little tiny moves. It's a game of constant navigation. But the long-term investor, they have a completely different goal. Their whole aim is to make one single great decision, find a wonderful business with incredible management, and then let that management team navigate the messy, unforeseeable future for them. It's a huge shift from trying to be the pilot to just owning the airline.
Okay, so this all sounds great in theory, right? But does it actually work? Does this patient, long-term approach really pay off in the real world? Well, let me tell you, the numbers don't just speak for themselves here. They absolutely scream. Let's take a look at the math. All right, so here's the challenge. Let's say we start with $10,000. The goal is $1 million. We can take 2 paths. There's the trader's path, making a series of perfect 100% gains. Or there's the investor's path, finding one great company that just doubles in value again and again. Which one do you think gets you to that $1,000,000 goal? Okay, I want you to look really closely at this table because this is where everything clicks. Both accounts start with 10 grand. After the first double, the investor has 20,000. Simple. But the trader, after paying about 30% in taxes and fees on that gain, is left with only 17,000. Now the gap is pretty small at first, you might not even notice it, but just watch what happens. By the fourth doubling, the investor is at $160,000 while the trader has barely half of that. That constant friction of taxes and fees is just a brutal, relentless drag on performance. And by the time we get to 8 successful doubles, well, the difference is just staggering. So after 8 perfect, back-to-back trades where they doubled their money every single time, which is an almost impossible thing to do, the trader ends up right here, well short of that $1,000,000 goal. They made all the right moves, they created a whole lot of shavings, but the relentless drag of the system just held them back. And the patient investor? What about them? After those same 8 doublings, their account is worth more than $2.5 million. And even if they sold everything and paid a massive 30% tax bill on the entire gain, they'd still walk away with nearly $2 million. The math here is just inescapable. One great decision, held patiently, absolutely demolishes a whole series of pretty good ones. So the numbers are crystal clear. But it's not just about the math. There's a deeper, more fundamental advantage to thinking this way. And it's a bit of a paradox, really. It turns out that seeking these massive home run returns can actually be a safer way to invest. Now I know, that sounds completely backward, doesn't it? Aiming for a grand slam feels way riskier than just trying to hit a single. But the logic here is completely sound. See, when you're constantly trading, you're constantly trying to predict the near future, which, as we all know, is notoriously unpredictable. But when you buy a truly great business, you let time become your single greatest ally. So let's just quickly break down why this is actually a safer approach. First off, quality always sells. There's always a market for the best of anything, so you're never stuck holding something nobody wants. Second, and this is huge, you don't have to try and outsmart anybody. You're not playing a game of musical chairs hoping to sell your stock to some other guy before the music stops. You're a long-term partner in a growing business. Third, time is on your side. It smooths out all the market's emotional freakouts and lets the real value of the business shine through. Fourth, a truly great company is like a better mousetrap. Its success eventually becomes obvious to everyone. And finally, you avoid the trap of trying to reform a bad company. And this is just fantastic advice that follows right from that last point. We've all seen those turnaround stories. You know, companies supposedly on the verge of some massive comeback. But the hard truth is, a lot of the time, that comeback you're hoping for just never happens. You're so much better off just starting with quality from day one. So, what does it actually take to do this? Well, it's not about being smarter than everyone else or having some secret information. It's really all about a fundamental shift in your mindset. You have to stop thinking like a stock trader and start thinking like a business owner. The author of our source material here shares this with a wonderful sense of humility. And he's right, this isn't easy. He openly admits he learned all these lessons the hard way by making his own mistakes. This wisdom is earned through experience, not just learned from a book. And that makes it all the more valuable. Let's look at a perfect real-world example. On the left, you've got the market's view of Pfizer for a long stretches of time. The stock price was just frustrating, going sideways, or even down for years. Any short-term, performance-minded trader would have dumped it in a heartbeat. But on the right, you see the business reality. Sales, earnings, and dividends were all marching steadily upward. The business itself was thriving, even when its stock price wasn't. And this, right here, is the ultimate payoff. The person who owned a piece of the Pfizer business and just watched those fundamentals could have slept soundly at night, totally confident in their investment. But the person who only watched the daily stock price, they would have been a complete nervous wreck, and they probably would have sold at the worst possible time. It's the difference between peace of mind and just constant anxiety. So, at the end of the day, it all comes down to this one simple thing. The real secret to finding those melons in the field is to shift your focus away from the flickering prices on a screen and onto the real underlying earning power of the business, its ability to consistently generate profits year after year, no matter what the stock market's mood is. It's a simple concept, but it is not easy to practice. It takes patience, it takes conviction, and it takes the ability to ignore a tremendous amount of noise. The real question isn't whether it works. The question is, can you do it? All right. Let's talk about an investment philosophy that feels almost radical today, even though it's as old as the hills. Buy right and hold on.
It's a strategy that flies in the face of everything we're told about the fast-paced, always-on world of modern finance. And we're about to see why this forgotten art might just be one of the most powerful tools you have. I mean, really think about that for a second. In a world of blinking lights, 24/7 news, and constant notifications telling you to buy, sell, react, what if the smartest, most profitable move you could make is to just put your hands in your pockets and do nothing? It's a pretty challenging thought, isn't it?
Now, we're not just going to talk about this in theory. Forget the textbooks. We're going to dive deep into a real-world story, a fantastic case study of an institution that put this art of sitting still to the test, not for a year or two, but for decades. Okay, so if the strategy is so great, why isn't everybody doing it? Why is it a forgotten art? Well, the roadblock isn't what you'd think. It has almost nothing to do with picking the right stocks. It has everything to do with what's going on between your ears. And this quote just nails it. The real challenge isn't a lack of intelligence, it's a lack of pure, old-fashioned willpower. The psychological pressure to do something, anything, when the markets are tanking is just immense. Your gut is screaming, sell, get out. The hardest part of this whole thing is simply to hold on through those bad years. But some people have actually managed to pull it off. And that brings us to our case study, what we're calling the Rochester experiment. We're going to take a close look at the incredible multi-decade journey of the University of Rochester's endowment fund. And the man at the center of our story is Holbert W. Tripp. Now, this wasn't some Wall Street celebrity you'd see shouting on TV. He was the exact opposite. He was the chairman of an investment committee who quietly and methodically put this powerful idea into practice for a very, very long time. So, what did this actually look like day to day? What was the secret sauce? Well, it wasn't some complex algorithm or a secret market timing signal. It was built on one incredibly powerful and refreshingly simple idea: conviction. Tripp basically believed that what most people call diversification, owning hundreds and hundreds of stocks, was really just a way to avoid the hard work. He saw it as hiding in a crowd. His approach was the polar opposite. Find a very small number of truly fantastic companies, and then bet big on them, because you've done the work to know them inside and out. And this is what that philosophy looks like in the real world. Just look at these numbers. From 1966 to 1970, their portfolio hardly changed at all. They started with 29 stocks, ended with 27. And get this, 14 of those companies, almost half the portfolio, were the exact same ones they held 4 years earlier. In today's hyperactive market, that's an eternity. And if the last slide was the hold on part, this number is the conviction part. The average amount they invested in a single company was almost $10 million. Let me say that again. In 1970, that is a staggering amount of money. This wasn't a casual bet. It was a massive vote of confidence in every single business they owned. Okay, so we've got the philosophy, we've got the conviction. They had the guts to go big and stay put. But here's the $100 million question. Did it work? Let's zoom out and look at what happened over 20 years. This timeline really shows you the scale of their commitment. And what's fascinating is how their belief grew even stronger over time. Look, they started in 51 with less than half the fund in stocks. But by the end, in 71, they had over 72% of the fund in stocks. They didn't just hold on, they actually doubled down on what was working. But here's where the real magic happens. And it's not just about rising stock prices. Look at the income the portfolio was spitting out. For every dollar they originally put in, the book value, the amount of cash it generated each year more than doubled. It went from about 4 cents on the dollar to over 11 cents. The entire portfolio just became this incredibly efficient cash machine.
And here it is, the knockout punch. The actual, real, spendable cash the university got from its investments went up by over 327%. Just let that number hang in the air for a second. 327%. Their cash flow more than quadrupled in 2 decades. That is staggering. Now, here's the detail that makes that number so incredible. Over that same time, the amount of new money they added to the fund only went up by about 60%. So they didn't get these results by just throwing more and more money at the problem. No, the money they already had was just working harder and harder and harder for them over time. That, my friends, is the power of buying right and letting your winners run. Okay, now before we all run out and build our own 27 stock portfolios, we've got to pump the brakes just a little. As amazing as these results are, it's important to have some perspective. This isn't a silver bullet. Let's be totally transparent. If you put Rochester's numbers up against a fund from the same era that was 100% pedal to the metal invested in stocks, well, the all-stock fund grew faster. But that's kind of like comparing apples and oranges, isn't it? Rochester was a balanced fund. They had to be responsible, so they owned safer things like bonds too. For a balanced fund to put up the kind of numbers they did, it's just absolutely world-class.
And this brings us to what might be the most crucial piece of wisdom in this whole story. Beware the one-answer man. There is no single strategy that is perfect for everyone in every situation. The goal here is not to blindly copy what Hubert Tripp did. It's to understand the timeless principles that made him so successful.
So, what's the practical takeaway for us today? How do we actually apply this lesson? Well, the source material gives us this really wonderful analogy to think about. You see, you don't have to blow up everything you're doing right now. Think of it like a pro golfer's swing. They don't reinvent it from scratch every season. But a tiny, almost imperceptible change in their grip can be the difference between a good shot and a great one. It's about making a small, powerful shift in your mindset that can have an outsized impact on your results. And it really all boils down to these two little mental adjustments. First, when you buy something, shift your mindset. Start thinking of it as a permanent holding, something you're buying for keeps. And second, have a little more grit. Be a little more determined not to sell your big winners. We all get that itch to lock in profits. You have to fight that urge and let the magic of compounding do its work. And so that's the final question I want to leave you with. Tonight, or the next time you look at your investments, take a hard, honest look. Is what you own built on true, long-term conviction, or is it really just a collection of lottery tickets? A bunch of fleeting hopes you're praying will go up next week? As the University of Rochester experiment showed us, the answer to that question could truly change your financial future. Thanks for joining me. Welcome to The Explainer. You know, there's a question that I think, deep down, every one of us has wrestled with at some point. Should I just be managing my own money? It's so tempting, isn't it? The idea that you could do it better, that you could be the one to find that next big thing. But here's the thing. Making that choice, it really forces you to take a long, hard look in the mirror. It's about weighing that ambition against what you can actually do. So today, let's break down how you can find the right answer for you. Okay, so this is a heck of a way to kick things off, right? This quote just frames the whole discussion around risk. And it does it perfectly. I mean, we all get it when it comes to the law. The stakes are incredibly high, you need specialized knowledge, you don't mess around. But the real question for us today is, does that exact same logic hold true for our financial lives? And then there's the flip side. This right here, this is the siren song, the dream of finding that one investment that changes everything. Paul Garrett is the legend. He's the guy who made a bet on a tiny little company called Hallowed, which, you might have guessed, eventually became Xerox. And it made him a fortune. It's the ultimate DIY success story, and it gets that little voice in your head whispering, hey, maybe I could do that. And you know what? The answer isn't a simple yes or no. It really depends on how you answer some very tough, very honest questions. All right, so here's our roadmap for digging into this. First, we'll really frame the DIY question itself, the dream versus the reality. Then we'll get to the heart of it with a 4-question self-assessment. If that test tells you that maybe DIY isn't the path, we'll talk about how to find a financial doctor you can actually trust. And we'll wrap up with the one mindset that is absolutely crucial for success, no matter which road you take. So let's start right here with this fundamental conflict. On one side, you've got the dream, that 100-to-1 home run. But on the other, you have the cold, hard reality of the insane amount of work, the risk, and the deep knowledge it takes just to get a ticket to that game. And that brings us to what I think is the most important part of this whole discussion, this 4-question self-assessment. Now, this isn't an IQ test. This is all about being brutally, unflinchingly realistic about your own skills, your own dedication, and your own temperament. And here it is, question number 1. And I want you to pay close attention to that word real. This isn't about just being smart or having a good feeling about something. It's about having a concrete, provable edge over the thousands and thousands of other incredibly smart, incredibly hardworking people who are all trying to do the exact same thing. You know, there is this great story that just nails this idea. The president of Emerita Petroleum gets a call at the office on a Saturday afternoon. He picks it up himself, and when asked, he just starts reciting oil well depths right off the top of his head, from memory. Now that is an edge. That's what it looks like. That level of obsession, that intimate, granular knowledge. It's not a hobby. That's a real, tangible advantage. So what does a real advantage actually look like in practice? Well, it could be specialized education you have that nobody else does. Maybe it's a network of contacts in a specific industry that gives you insights others can't get. Or maybe you just have a genuinely superior way of thinking analytically. Or, and don't discount this, maybe it's just a raw, unadulterated willingness to outwork everybody else in the room. You have to ask yourself, honestly, do I have one of those?
Okay, on to question 2. And this one is all about the grunt work. Because let's be real, finding one of these incredible investments isn't about getting a lucky stock tip at a cocktail party. It's an industrial scale process of elimination. It's about wading through mountains of hay to find that one tiny needle. And that takes an almost unbelievable amount of effort.
Let's go back to Paul Garrett and his Xerox miracle. You want to know how he did it? He didn't just stumble upon it. He and his friends started by screening over 50,000 companies. Think about that number. From that massive list, they painstakingly whittled it down to just 50 promising ones. Then they analyzed those 50 to death to get to a final 3. And only then, after all that exhaustive study, did they make a choice. So the question is, are you really prepared to do that?
This third question, this one's a gut check. It moves away from the work and into your own psychology. Because choosing your own investments, especially if you're making a call that goes against the crowd, can be one of the loneliest, most stressful things you can do. Imagine your big idea is down 30–40%. Your stomach is in knots. Everyone thinks you're crazy. Can you really handle that pressure all by yourself? I mean, just try to put yourself in this situation. It's 1946. You buy into this incredible, revolutionary company, Polaroid. And then you watch for 3 long years as the stock gets cut by more than half. Every newspaper, every expert, every friend is probably telling you to sell, that you made a huge mistake. To hold on through that kind of pain, that doesn't just take guts. It takes an almost superhuman level of conviction. And that right there leads us straight into the fourth and maybe the trickiest question of all. Because having the courage of your convictions is a virtue, right? It's what separates the greats. But being stubbornly blind to the facts, refusing to admit you made a mistake, well, that's a fatal flaw in this business. How in the world do you know which is which? There's a razor-thin line between being a hero and being a fool.
So, this is the moment of truth. You look at those 4 questions. Do I have a real advantage? Am I prepared for the work? Am I emotionally strong enough? And can I tell conviction from stubbornness? If you can't look yourself in the mirror and give a confident, resounding yes to every single one, that's okay. That's not a failure. In fact, it's a sign of wisdom. It's a sign that the smartest, most profitable move you can make is to find some good professional help.
All right, so let's say you've done that honest self-assessment and you've decided, you know what? I need a pro on my team. Fantastic. But how do you find the right financial doctor? And maybe even more important, how do you know if the one you have is actually doing a good job? Well, let's look at a few really practical tests you can use. Here's the first tool for your toolbox. It's called the advantage-disadvantage test, and the idea behind it is beautifully simple. The only good reason for anyone to make a change in your portfolio, to sell one thing and buy another, is if it actually makes you richer in the long run. This test is how you measure if that's really happening. And here's how you do it. It's pretty straightforward. Step 1, just make a note of what your advisor sells. Step 2, you wait. And this is key. You have to be patient. Give the decision at least a year to play out, maybe even longer. Then, step 3, you do the comparison. You look at what you now have versus what you would have had if you'd just done nothing and held on to the old investment. It's a simple but incredibly powerful accountability check. Okay, test number 2. I gotta say, I love this one because it's so direct. It's the on you versus for you test. On one side of a piece of paper, you tally up everything your advisor is making on you. That's all the commissions, the management fees, the charges, everything. Then on the other side, you write down what they are making for you, the actual real dollar growth in your account. The math is simple. You want the number on the right to be a whole lot bigger than the number on the left. And finally, there's a third thing to watch: turnover. That's just a fancy word for how often stuff is being bought and sold in your account. And I want you to think about it this way. A lot of activity, a high turnover rate, is usually a red flag. The goal is long-term growth. You're trying to plant an oak tree, not a flower bed you have to replant every season. That line says it all. Every sale should be recognized as a confession of a lost opportunity.
It means the last decision wasn't the right one for the long haul. And all of this brings us to our final and maybe most important section. This is about the fundamental mindset you need for creating real long-term wealth. And this is true whether you're doing it yourself or you're working with a pro. It all boils down to something simple but so powerful: the mathematics of patience. Remember that 100-to-1 dream we started with? It sounds like winning the lottery. Just impossible. But let's look at the actual math. To turn $1 into $100 over a 40-year period, you know what you need? You need to earn a compounded annual return of 12.2%. It's not magic, it's just consistent, solid, above-average performance held over a very long time. And hey, let's just say you'd be thrilled with a 50-to-1 return. I mean, who wouldn't be? Well, the rate you need for that drops to just over 10% a year. What these numbers do is they bring the fantasy down to earth. They show us that these extraordinary, life-changing results don't come from some miracle stock pick, but from getting very good returns and just letting them work their magic year after year after year. And so here we are right back at that core psychological challenge. To get those amazing long-term returns, you have to be able to hold on through thick and thin. You need that conviction. But how do you know if you're being savvy and patient, or if you're just being a stubborn mule, refusing to admit you're heading in the wrong direction? So we're going to end with the one question that really gets to the heart of everything we've talked about today. Because whether you go it alone or you hire the best professional in the world, your ultimate success is going to depend on your character. It comes down to this: can you honestly tell the difference between the brave courage of conviction and just a foolish, mulish refusal to admit when you're wrong? That's not a question I can answer for you. That's the question you have to live with and answer for yourself as an investor. You know, we're always told that the key to getting ahead, especially in investing, is foresight. It's about seeing the future before anyone else. But what if I told you that being right about the future by itself is almost useless? What if it could actually be the thing that leads you to lose a ton of money? Well, today we're going to dig into that. We're going to talk about the crucial and often totally ignored second ingredient for any success: a real, solid sense of value. It's all about the difference between predicting the future and actually making a profit from it. Just let that sink in for a second. Being right is a way to be wrong. How does that even work? Well, it's this exact paradox that's at the heart of so much financial pain. I mean, think about it. You could have seen the internet coming from a mile away. You could have known smartphones would take over the world. But if you paid too much or you got in way too early, that brilliant foresight of yours was completely worthless. It's a tough lesson, and that's exactly what we're going to unpack. So yeah, this is the big question, isn't it? What good does it do you to know for a fact that a company is going to triple its earnings if you paid 4 times what the company was actually worth to buy its stock? The answer is none. No good at all. You just paid a massive premium for a future that, yeah, it came true, but it wasn't profitable at the price you paid. This is the trap, and we're going to learn exactly how to sidestep it. All right, so here's our game plan. First, we're going to really establish why just having foresight won't cut it. Then we'll get practical and look at a 5-question framework you can use to figure out what something's really worth. To make that stick, we'll use a super simple analogy about hens and eggs. After that, we'll dive into our own psychology, why we keep making these bad deals. And to wrap it all up, we'll see how this all comes together in the mind of a truly great trader. Okay, let's jump in. You know, every legendary investment story seems to start the same way. Someone saw a future that nobody else did. But that story only has a happy ending if that amazing vision was paired with something else, this kind of hidden element, a rock-solid grasp of value. Without that, you're not really investing, are you? You're gambling on the future. Man, this one sentence just says it all, doesn't it? It's the story of countless people who saw what was coming, got all excited, and just started throwing money at it without asking one fundamental question. Okay, but what is that future actually worth in today's money? And remember that example, paying 4 times the value for something that only triples is a losing game from the start. Your brilliant prediction can't dig you out of that hole. Okay, so a huge piece of this value puzzle is an idea called the time value of money. It sounds complicated, but it's really, really simple. A promise to get $1 10 years from now is not the same as having $1 in your pocket right now. And why is that? Well, because the dollar you have today, you can invest it. You can put it to work. So time, plus all the risks along the way, it basically chips away at the value of those future promises. And get this isn't just theory. It has a massive impact in the real world. Just look at these numbers.
A dollar that you're hoping to get 10 years down the line is only worth about 61 cents today, if we assume, say, a 5% discount rate. That's kind of like a baseline for risk and what you could earn elsewhere. But what happens if interest rates go up and that discount rate jumps to 9%? Whoa, suddenly that same future dollar is only worth 42 cents. Its value just plummeted by almost a third. This is exactly why high-flying tech stocks that promise huge profits way off in the future get absolutely crushed when interest rates rise. That far-off future just got a whole lot less valuable. So if having foresight can be a trap and future money is a shrinking target, how in the world do we protect ourselves? Well, we need a system, a process. And that brings us to our next section, the 5 essential questions. Think of this as a practical checklist for finding the true value of pretty much any opportunity. So instead of getting all caught up in a great story about what's going to happen tomorrow, this framework forces you to hit pause, to actually think, and to act like a disciplined pro. It's what turns a hopeful guess into a calculated risk. These 5 questions are basically your shield against overpaying for your own excitement. All right, here they are. First, what's this thing worth if my brilliant prediction doesn't happen? That's the status quo value. Second, how long is this going to take? Be honest. Third, once you factor in time and risk, what's that future gain really worth today? That's the present worth. Number 4, and this one is so important, how much of that good news is already baked into the price I have to pay? And finally, the most critical question of them all, the one that is your ultimate safety net. Is there a margin of safety? Is there enough potential upside left to not only reward me for being right, but to protect me if I'm wrong, or if it just takes way longer than I thought? Okay, I get it. Those questions can feel a little abstract, a little academic. So to make this idea of value and having a margin of safety totally clear, let's use a really simple story about some chickens and their eggs. I mean, it seems like a no-brainer, right? You've got this super productive flock, and then you have one that's basically a slacker, only half as good. The 80-egg flock has got to be the winner. But here's the thing about investing. The best asset is not always the best bargain. The price you pay for it, well, that changes everything. So let's do the math. Let's say you could buy that high-producing flock for $80, but the owner of the 40-egg flock, he's feeling down, he thinks his hens are worthless, and he's willing to sell them for just $20, a quarter of the price. Now, which one is the better deal? Well, at that cheap price, you're only paying for the value of 20 eggs a day, but the flock is actually giving you 40. The seller is essentially handing you 20 eggs a day for free. That is your margin of safety. And here it is, the big punchline. By buying the less productive flock at a huge discount, you've totally flipped the script. Your potential reward is massive and your risk is tiny. If production just stays at 40, you've doubled your money in egg profit. If, by some miracle, they get back to laying 80 eggs a day, your profit is 300%. You've set it up so the seller is the one taking all the risk if things go wrong, not you. That is what it means to buy with a margin of safety. You know, the hen analogy makes so much sense, it almost seems like, how could you ever get that wrong? And yet, we do. We get it wrong all the time. Which brings us right to our next section. Why are we so bad at making good bargains? Well, the answer has a lot less to do with spreadsheets and a lot more to do with what's going on inside our own heads. So here are some of the usual suspects. I think the biggest one is that we don't hit the pause button. We get emotional, we buy something just because it looks cheap without asking what we're actually getting for our money. We get fooled by high prices thinking, oh, it must be good if it costs that much. And maybe the most common one of all, we chase momentum. We buy something just because the price is going up. It's like a fish seeing a shiny lure wiggle by. We just can't help but strike without ever checking to see if there's a hook inside. Let's just zero in on that one trap for a second, buying on price alone. It is so tempting. It's the siren song of the clearance rack, right? This belief that if it's cheap, it must be a good value. This is, without a doubt, one of the most dangerous and costly mistakes you can make, in finance or in life. And wow, this quote just says it all. The writer John Ruskin figured this out over 100 years ago. He said, there's hardly anything that cannot be made a little worse and sold a little cheaper, and those you buy on price alone are that man's lawful prey. When you only look at the price tag, you forget to ask about the quality, about the value, and that's when you become an easy target.
And things get even weirder because the market is like a magnet for these extreme personality types that make rational decisions almost impossible. You've got the egotist who is so in love with his own ideas that he literally rather lose money on them than make money using someone else's idea. And then there's the masochist who, well, it almost seems like they enjoy losing money. Like every loss just proves their pessimistic view of the world is right. It's just a powerful reminder that so much of this is about psychology, not economics. So let's wrap all this up with a great story that brings every one of these ideas together: foresight, value, and that psychological discipline. This is a perfect case study in what it looks like to really truly see value when no one else does. Okay, picture this. The year is 1961. The bowling craze is absolutely sweeping America, and the hottest stock on the market is Brunswick, a company that makes all the bowling alley equipment. It's trading at an all-time high of $70 a share. The future looks amazing, all the news is good, and right in the middle of all this excitement, this one investment manager, a guy named Peter Falk, quietly sells every single share he owns.
So a colleague comes up to him and asks, "Peter, why on earth are you selling the best stock on the market?" And his answer had nothing to do with earnings reports or PE ratios. It was simple. It was brilliant. He just said, "Too many bowling alleys catching fire." See, he looked past the Wall Street hype and he saw what was happening in the real world. He realized these fires, many of them for insurance fraud, were a clear signal that the boom was over, the market was saturated. He had foresight, sure, but he backed it up with a cold, hard sense of real-world value. Just 4 years later, that same Brunswick stock was trading for $6.
And that really is the perfect thought to end on. Because when you think about it, life is really just a long series of trades. Every single day, we trade our time, our money, our energy for something else. The lesson from Peter Falk and the hens and those 5 questions, it isn't just about stocks. It's about everything we do. So the question I want to leave you with is this. In all the trades you make in your life, are you paying for the reality of the value you're getting? Or are you just paying for the hope?
You ever see one of those stock charts that just goes vertical, and you think to yourself, how? What is the secret sauce? What's the actual formula that takes a totally normal company and turns it into an absolute wealth-generating machine? Well, guess what? Today, we're cracking that code. We are going to break down the timeless principles behind the stocks that create legendary growth.
All right, let's get right into it. You know, the holy grail for any investor, the thing we all dream about, is finding that 100-bagger, a stock that turns every dollar you put in into $100. It sounds like a fantasy, right? But it happens. The real question is, how? I promise you, it's not luck and it's not magic. It's a recipe. And in this explainer, we are going to lay out every single ingredient. So, first things first. Before a company can even think about changing the world, it has to get its own house in order. That's why we're kicking things off with part 1, the internal growth engine. This is all about what's happening inside the company, the financial levers it can pull to create value from the ground up. The absolute bedrock of growth. It all starts right here. We're not talking about flashy new products or a marketing hype. Not yet. It all boils down to a simple question. What does a company do with the profits it's already making? Does it hand that cash back to shareholders? Or does it plow that money right back into the business to make even more money? The answer to that question changes everything.
Now, to really get this, we've got to talk about a key term, book value. The easiest way to think about it is it's the company's net worth. You know, if they sold everything and paid off all their debts, what's left over? That's the core capital, the seed money that the business has to play with. And watching how this number grows, that's the first clue in our formula.
Let's make this real with a simple example. Imagine we've got a company, and its book value is $10 a share. It's a pretty good business. It earns a solid 15% return on that capital. But here's the crucial part. It decides to keep and reinvest every single penny of its profit. No dividends, just pure reinvestment.
So, what happens after 1 year? Well, that reinvestment pays off. The company makes its 15% on those $10. That's $1.50, and it funnels that profit right back into its capital base. So, just like that, the book value grows to $11.50. Pretty straightforward, right? Okay, but this is where the magic really starts to happen. In year 2, the company earns 15% again, but this time it's earning it on that bigger base of $11.50. The profit is now higher, so the book value jumps up to $13.22. You see what's happening? This isn't just steady, straight-line growth, it's accelerating. That is the incredible power of compounding at work.
This really brings up a critical choice for us as investors. A company paying out its profits and dividends, that's like a milk cow. It's great, it gives you a steady stream of income. But a company that reinvests all its profits? That's a racehorse. It's built for one thing: speed and capital growth. And this quote just nails the trade-off, right? You can't have both. If you want maximum growth, you gotta back the racehorse.
Okay, so reinvesting profits is gear number 1 for the internal engine. But there's another lever a company can pull to really juice its returns, using other people's money. Let's talk about debt or leverage.
Now, borrowing money is the classic double-edged sword. On one hand, it can be amazing. I mean, if a company can borrow money at, say, 5% and then invest it into projects that earn 10%, guess what? All that extra profit goes straight to the shareholders. It amplifies the returns. But, and this is a big but, the downside is very, very real. Debt adds a huge amount of risk. If the business hits a rough patch, that debt can become a crushing weight that can even sink the whole company.
All right, that brings us to the third and final piece of our internal engine: growing by making acquisitions. This is where a company grows not by building something new, but by buying something that already exists. But for this to work its magic, it has to be done in a really specific, financially savvy way.
This table here shows what looks like a magic trick. Let's walk through it. You've got Company A, the buyer. It's a popular stock, so the market values it highly. Then you have Company B, the target. It's a solid business, but maybe a little boring, so it trades at a much lower valuation. Company A then uses its own high-priced stock as currency to buy the cheaper stock of Company B. Now look at the bottom line. The new combined company's earnings per share has instantly jumped from Company A's original dollar all the way up to $1.28. On paper, this looks like incredible growth. But, and this is the key, the actual businesses themselves haven't gotten any better. It's pure financial engineering.
Okay, so we built our internal financial engine. It is tuned up, it's humming along, it's ready to go. But you know, an engine is totally useless without fuel. And that brings us to part 2, fueling the business machine. This is where we shift gears from financial spreadsheets to the real world, the actual activities that power a company's growth.
So where does this fuel come from? Well, our source material boils it down to 4 main categories. You can grow just by being more efficient with what you've already got. You can literally discover something new in the ground, like oil or minerals. You can invent some breakthrough new technology. Or you can simply expand your operations and sign new contracts. Let's dig into a couple of these.
You know, the simplest kind of fuel is just increasing your sales without spending a ton more money. And the hotel analogy is perfect. Think about it. If you own a hotel that's only half full, filling those empty rooms makes your revenues skyrocket, but your costs, your mortgage, your staff, they barely change. Almost all that new money drops right to the bottom line. It's pure efficiency.
Now, growth from new inventions, that is a whole different ballgame. It's way more unpredictable. I absolutely love this quote from the old Mobil Oil Company. It just perfectly captures the spirit of true innovation. Real research is a journey into the great unknown. If you already know it's going to work, you're not doing research anymore. There's supposed to be risk and uncertainty.
So let's be real. If the brilliant PhDs inside a company don't know for sure which project is going to be the next big thing, how on earth are we as investors supposed to know? Well, we can't. And the big takeaway here is that you don't try to bet on a specific invention. You bet on the organization. You find the company that has a culture and a track record of successful innovation over and over again. You back the proven winner. All right, let's recap. We've built the engine, we've added the fuel, the business is firing on all cylinders. Now we get to the final, and honestly, the most explosive part of our whole formula. We have to talk about the single biggest accelerator of them all, the stock market itself. Welcome to part 3, the market's multiplier effect.
To understand this, we have to get really clear on the price-to-earnings ratio, or PE. On the surface, it's just the stock's price divided by its annual earnings. But what it really is, it's a measure of market expectation. Think of it like a sentiment meter, or a hype meter. A high PE means investors are super optimistic and they are expecting massive growth in the future.
And folks, this is the aha moment. The journey of a truly great stock isn't just about its earnings going up. That's only half the story. The other, more powerful half is that as the company keeps proving how great it is, the market's perception totally changes. Investors get more and more excited, and they start paying a higher and higher price for every single dollar of those earnings.
Just look at the insane power of this phenomenon on this slide. Let's walk through it. Our company does an incredible job, and it triples its earnings per share, from $1 to $3. Now that alone is great. That would triple the stock price. But watch what happens to the PE ratio. The market sees the success and the enthusiasm just explodes. The PE multiple also triples, from a pretty normal 15 up to a super premium 45. And the result? You multiply the 3x increase in earnings by the 3x increase in the PE ratio, and you get a staggering 9x increase in the stock price. It goes from $15 to $135. That right there, that is the supercharger.
So there we have it. We've looked at the internal engine, we've looked at the real-world fuel, and we've seen the market's incredible reaction. Now, it's time to put all the pieces together and look at the complete three-part formula for how extraordinary stock growth actually happens.
Here it is, the entire framework in one place. Step 1. The company builds a powerful internal financial engine. It masters reinvestment, it uses leverage wisely, and it makes smart acquisitions. Step 2. It powers that engine with real-world fuel from its business, more sales, new discoveries, constant innovation. And finally, Step 3. The market sees this amazing combination and it hits the accelerator, rewarding the stock with that rising PE multiple that supercharges the whole thing.
So, let's end with this thought. This isn't just some abstract theory. This is a practical lens, a framework that you can use to analyze any company out there. It's timeless. The big question for you now is to look at today's market and ask yourself, which companies do you see executing this three-step formula? Who is building the engine, adding the fuel, and is maybe just on the verge of the market hitting that accelerator? That's for you to think about. Thanks for watching.
All right, let's talk about growth. As an investor, it's what we're all looking for, right? But here's the million-dollar question. How do you know if you found the real deal, the kind of company that creates serious long-term wealth, or if you've just stumbled on a flash in the pan? That's exactly what we're going to break down today.
So here's our game plan. We're going to start by pulling back the curtain on a really common trap called the earnings illusion. Then we'll get into the good stuff, what true earning power really is. I'll give you a 6-point checklist to hunt for it yourself, and we'll see it in action with an incredible case study on Tampax. After that, we'll talk about the psychology that can pour rocket fuel on your returns, and we'll wrap it all up with a simple but super powerful philosophy: buy right and sit tight.
Okay, first things first, let's talk about one of the biggest mistakes I see investors make, time and time again. You see a company's profits pop, the stock goes up, and you think, hey, this thing's a winner. But that assumption, it can be really, really dangerous. We've got to learn to see the difference between a temporary sugar rush and real, durable, long-lasting earning power.
Yeah, this quote just nails it, doesn't it? A stock's price can go on a wild ride because of some headline, a bit of market fear, or 1,000 other reasons that have zero to do with whether the actual business got any stronger or weaker. And you know what? Those reported earnings can be just as noisy.
To really make this stick, let me give you an analogy. Think of those temporary earnings on the left as a cork bobbing down a river. Yeah, it's moving, but it has no power of its own. It's just getting carried along by the current. Maybe that's a hot economy or a weird surge in demand. Now look at the right side. That's earning power. That's not a cork. That's a speedboat with its own engine. It has its own motive power. It drives forward year after year under its own steam because it has a real competitive advantage. We're not here to find corks. We're here to find engines.
Okay, so if we can't always trust the big headline profit number, what are we supposed to look at? Well, this brings us to what I think is the single most important idea we're going to cover. It's all about earning power. This is the engine we need to learn how to spot. So what is it really? Earning power isn't about one good quarter or one good year. It's the deep underlying strength of the business, its moat, that lets it consistently, year after year, make great returns on the money it reinvests. It's all about the quality and sustainability of the profits, not just the raw number. So if earning power is the engine, think of these as the gauges on the dashboard. How do you know it's a good one? Well, you look for these vital signs. Is it consistently earning high returns on its capital? Are its profit margins fatter than the competition? Is it growing sales faster and more reliably? These are the clues that tell you you're looking at a high-performance machine.
Right, this all sounds great, but how do you actually find these companies? How do you measure this stuff in the real world? That's what this next part is all about. We're opening up the toolbox now.
Okay, here's the checklist. But before we even get into it, there is one golden rule, and you absolutely have to follow it. You cannot look at these numbers for just 1 year. That's totally useless. A single year is a snapshot, and snapshots can lie. You need to track these metrics over 5, maybe even 10 years. You're not taking a picture, you're watching the whole movie. That's the only way to see the real story. All right, enough theory.
Let's see how this all comes together in the real world. And oh man, this is a fantastic example. This isn't just a story about a company. It's a perfect lesson in how two things, the hard numbers of a business and the soft psychology of the market, can combine to create absolutely staggering wealth. Let's dive into the classic case of Tampax.
Let's start with the absolute foundation of the business itself. This table shows the company's book value per share. And all book value really means is, if they sold off all their assets and paid all their debts, what would be left for the shareholders? Now just look at that climb, that steady, powerful march upward over 15 years. That right there is the bedrock on which all the incredible returns were built.
You do the math, and that steady climb means the real underlying value of the business multiplied by more than 8 times. And here's the beautiful part. This wasn't some complicated financial magic trick. It came from one simple, powerful source: making a lot of profit and being disciplined enough to plow it right back into the business.
Now this chart, this is where the light bulb really went on for me. It shows you exactly where that 8x growth came from. Look at that giant bar on the left. Of the total increase in value, almost all of it came from retained earnings. In plain English, they made money and they kept it to reinvest and make even more money. That is pure organic growth. It's exactly what we're looking for.
And this brings us to a really powerful idea. When you find a great company that can consistently earn a high return on its money and it keeps reinvesting those profits, while the growth stops being magic and it starts becoming simple math, it's predictable. The business becomes a wealth creation machine.
Let's just play this out for a second so you can see the power. Imagine a company starts with $10 of book value. If it can earn a 15% return and reinvest it all, after 1 year, it has $11.50. Now it's earning 15% on a bigger number. You see how this snowballs? In just 5 years, its book value doubles to $20. In 10 years, it quadruples to $40. That's the beautiful, relentless power of compounding.
So we've seen the powerful math inside the company. It's a compounding machine. But believe it or not, that is only half of the story for investors. The other half, the part that can turn a great return into a legendary one, has nothing to do with the company's financials. It's all about psychology.
Check this out. Back in 1956, investors were willing to pay about $13.50 for every $1 the company earned. That's its PE ratio. But you fast forward to 1971, the world realizes this company is a juggernaut, and now they're willing to pay $50 for that same dollar of earnings. That massive shift in what people were willing to pay acted like a giant multiplier on your investment returns.
And the lesson here is so important. The price you pay matters immensely. It's the difference between having the wind at your back or running straight into a hurricane. If you buy a great company when nobody cares about it and the PE is low, you get a double whammy of goodness. The business grows, and the multiple other people are willing to pay for it grows. But if you buy when it's the most popular stock on the planet with a sky-high PE, you're fighting a headwind. The business has to perform miracles just for you to do okay.
Okay, so let's put it all together. We've got the hard numbers of the business analysis. We've got the market psychology. It all boils down to a simple, powerful way of thinking. This is less about your calculator and more about your mindset.
You know, it really just comes down to these two questions. Before you put a single dollar into a company, for the long haul, you have to have a good answer for these. First, how strong is their competitive advantage, their gate or their moat? Can rivals just come in and steal their profits? And second, what's their runway look like? How much more room do they have to grow into?
And I just love this quote. It's a perfect and kind of funny reminder to stay humble. You can build the most beautiful financial model in the world that proves a company is unstoppable, just like the Great Wall. But the real world is messy and unpredictable. You always have to remember that a threat can come from somewhere you never expected.
Because in the end, making these life-changing returns isn't just an analytical exercise. The spreadsheet only gets you to the starting line. To actually win the race, it takes these very human qualities. It takes the vision to see the potential when no one else does. It takes the courage to act on that vision, to buy when it's scary. And maybe the hardest part of all, it takes the patience and tenacity to just hold on and let the story play out over years of ups and downs.
And that's the final thought I want to leave you with. It's the great paradox of investing. After all the research, all the analysis, all the hard work to find the right company at the right price, the most profitable thing you can often do is absolutely nothing. You have to learn how to stand still so that the powerful engine of the business can do all the running for you.
Hello and welcome. Today we're going to do something a little different. We are going on a trip back in time. We've got our hands on this really fascinating historical document that uncovers a very special kind of stock. Investments that created wealth on a scale that's, well, it's almost hard to wrap your head around today. We're going to explore how fortunes were built not by trading day to day, but through decades of patience and, as you'll see, some pretty wild corporate transformations. So let's dive right in. All right, so here's our game plan. First, we're going to lay out the blueprint. What exactly is a 100-bagger, or what this analysis calls a breeder reactor stock? Then we'll look at some absolute titans of industry, followed by the penny stock miracles. After that, we'll get into the really interesting stuff, the alchemy of mergers. Then, we'll reveal the single biggest winner of them all, the ultimate outlier. And finally, we'll pull it all together and see what lessons we can learn from these giants of the past. So let's just start with this question right here, because it gets to the absolute core of what we're talking about. Does this even seem real? I mean, a single $50 bill invested in 1932, the rock bottom of the Great Depression, turning into almost $500,000 in one person's lifetime. It sounds like a fairy tale, doesn't it? But as you're about to find out, it really, truly happened. And this is the kind of incredible power we're here to understand. Now, the source material for this whole thing gave these stocks a pretty cool name. A breeder reactor stock. The definition is simple, but wow, is it powerful. It's just any security that, over time, ends up selling for more than 100 times what you originally paid for it. Everything we're looking at today comes from a list of 365 of these securities, compiled back in 1971. It's like a perfect time capsule of how massive fortunes were made in the 20th century. Okay, first up, the titans. You might be thinking that to get these kinds of returns, you had to invest in some super obscure, high-risk company, right? Well, you'd be surprised. As we're about to see, some of the biggest winners were names that are now household words, companies that became absolute giants. What's so amazing about this table is just how familiar these names are. Look at Sears. You could have bought one share for $12.50 in 33, and it would have been worth almost $2,500. Or Johnson & Johnson, $44 after World War II, grows to over $5,000. And look at Walt Disney. Even as a later buy-in in 54 for less than $4, it turned into over $1,600. It just goes to show you, this kind of growth wasn't just for tiny speculative bets. But let's just hang on this one number for a second. $6,480? That's what a single share of Eastman Kodak was worth in 1971. A share you could have bought for just $46 back in 1933, right in the heart of the Great Depression. That's a 1,400 times return. It's just a perfect illustration of what can happen when you buy a fantastic company, even when the world feels like it's falling apart, and you just hold on. Now, of course, not everybody had $46 lying around in 1933. That was a lot of money. But here's the really cool part. You didn't need a lot of money to play this game. In this next part, we're going to see how literal pocket change, we're talking pennies, could have grown into a fortune. Just look at this list. And no, those are not typos. We are talking about stocks trading for actual pennies. You could grab a share of Allegheny Corp in 1941 for 13 cents. Or look down at the bottom, Old Ben Coal in 1935 was going for a nickel a share. A nickel! It's just wild to think about how many of these future powerhouse companies started out trading for less than you'd pay for a candy bar. Let's put some real numbers to it with this example right here. In 1933, you buy a share of a company called Celotex Corporation. It costs you 50 cents, 2 quarters. Over the years, that company changes, it evolves, and it becomes Jim Walter Corp. By 1971, your 50-cent investment is now worth $97. That's not a 100-bagger, that's a 194-bagger. You almost doubled the benchmark, starting with loose change. You know, that Celotex example where it became Jim Walter Corp? That actually leads us to a really critical point that runs through this entire list. The path to this kind of wealth often wasn't a straight line. It was full of twists and turns and corporate transformations. This is what we're calling the alchemy of mergers. And this is a huge takeaway. For a lot of these investments, you weren't just betting on one company to succeed, you're actually buying a little seed that would eventually get bought out or merged or totally transformed into something completely different and way more valuable. The name on your stock certificate could literally change and your entire financial future would change right along with it. Xerox is probably the most famous example of this. So imagine it's 1958. You buy one share of a small company called Haloid Xerox. They're working on this brand new technology, a photocopier. Well, that technology explodes. The company's growth is just off the charts. And through stock splits and appreciation, your one little share turns into 60 shares of the newly renamed Xerox. By 1971, that initial $47 has become more than $7,600. That's what corporate evolution can do. And it wasn't just about stocks. Get this. In 1932, you could buy a bond, a piece of debt, from a paper company for just $40. The company was in trouble, but through a whole series of reorganizations and mergers, that bond, that IOU, was eventually converted into over 110 shares of stock in a totally different company, Boise Cascade. That $40 bet on a struggling company's debt became over $5,000 worth of stock. Just amazing. All right, so we've seen the big household names, the penny stocks, the wild transformations through mergers, but now I want to show you the single most extreme, most mind-blowing example of a breeder reactor from this entire list of 365, the ultimate outlier. And here is the big surprise. Just like that last example, the absolute #1 best performer on the whole list, it wasn't a stock. It wasn't about owning a piece of a company. Nope. The greatest return came from buying the debt of a company that was on the verge of going bust, right at the darkest moment of the market. It was a corporate bond. Okay, so here are the raw details from the source. It was a first mortgage bond from a company called H.K. Porter. In a corporate reorganization, just one of these bonds, which you could have bought for next to nothing, was eventually converted into, get this, 19,101 shares of the company's common stock. Just let that number sink in for a second, from one bond. And here is the punchline. That one bond, which you could have picked up for $50 in 1932, became stock worth $448,873 by 1971. Let's be clear, that is not a 100-bagger, it's not a 1,000-bagger, it's an almost 9,000-bagger. An absolutely life-changing generational fortune from a $50 bill. This chart really says it all, doesn't it? That tiny, tiny sliver that you can barely even see, that's your initial $50. The rest of it, basically the entire circle, that's all profit. It's just a stunning visual of the mind-bending scale of this return. It's not just growth, it's a financial supernova. So, okay, these stories are incredible to hear, but they're more than just fun historical facts. They have these fundamental lessons baked into them about how real long-term wealth is actually created in the market. So let's try to pull out those key lessons. So what did we learn? Well, #1 has to be the incredible power of time. These weren't quick flips. These were multi-decade journeys. That time allowed the magic of compounding to kick in, turning small gains into huge ones. We also saw the huge role of corporate evolution. You had to be okay with your investment changing into something new to unlock its full value. Of course, all of that required an unbelievable amount of patience. You had to be willing to hold on through recessions, wars, you name it. And finally, you had to be a bit of a detective, finding value in obscurity. The biggest winners weren't always the ones everyone was talking about. And this chart just sums up the different ways you could get there. You could have done it by buying a future giant like Sears. You could have done it by scooping up a penny stock like Allegheny Corp for 13 cents and watching it turn into $18. Still a massive win. Or you could have hitched your wagon to a tech revolutionary like Xerox. The point is, there was more than one path to these incredible outcomes. And that really brings us to the big question for today. Everything we've looked at, this was the world of the 20th century, an economy built on manufacturing, retail, and the very beginnings of modern technology. So what about now? What are the forces, the new technologies, the massive social shifts that are creating the breeder reactors of our time, of the 21st century? That's the question this amazing look into the past leaves us with.